next half of the year, that's it. You can't use that tool for that. And there's a lot of research. It turns out we've done research since the 1958, and they're not using it. They're trying to excuse away. It's all demand driven. And if it is, the Fed does that. And the Fed is being very impatient, and it's hard to watch.
If we are ex post, if we are after the fact, what is the data we should look at if we are ex post? Claims isn't getting it done, isn't it? Because jobless claims look extraordinary right now. They look fully employed, frankly.
In a very unusual way, the Fed has painted themselves in a corner and said it is all CPI. The Consumer Price Index is the last place that the lower producer prices, the lower import prices, any kind of weakening, which we're already seeing, that's the last place it shows up. And they've told us they will not stop until it shows up there.
But earlier this year, you were talking about how we could see even disinflation, right? That we could see inflation roll over pretty dramatically heading into year end. We haven't. And services inflation has really been a big driver. It's not just rents. It's much broader. We just get the results from airlines. They're doing great, even though their tickets are incredibly expensive. So what have you gotten wrong with respect to the pace of the deceleration in inflation?
What I've gotten wrong is to look at the macro data. And in talking to businesses now, I mean, they have excess inventories. Why aren't you cutting prices? I mean, inflation is a business decision. They're the ones that write the price tag. And what they say is the consumers are here. Why would we cut back? And so I think the process of some of the supply disruptions, whether it's people coming back to work, whether it's like getting the goods here faster or the strong dollar feeding through, it's taking a lot longer than I would have expected. When I talk to business owners, I'm like, that makes sense.
Well, but this is the concern for the Federal Reserve and possibly the reason why they are being as aggressive as they are, because they had waited too long in the past. And that arguably is the reason why inflation accelerated to the pace that it did. If there is this uncertainty about why it's not coming down more, there is a big risk to not raising rates substantially. Isn't that right?
We're not in the 1970s. There was a decade of high inflation where the Federal Reserve was asleep at the wheel. We've had less than 2 years of high inflation, and the Federal Reserve has gone in big this year. Mortgage markets are showing us, wow, these are big increases and they're really fast. And we know long and variable lags. It takes time. And we also know that the rental market, what's happening right now, those prices are coming down. The Fed knows this. And they're going fast and hard.
Folding the international events here, I was thunderstruck at the IMF meetings how the adults down there have a much longer time frame back, 40 or 50 years, and they're much more looking at international dislocations than the parlor game of inflation rate dynamics. At what level is Jerome Powell, central banker to the world, driving the policy of all these different nations?
The Fed is absolutely in the driver's seat. I mean, the dollar has strengthened so much. He is pushing the ECB to raise rates, the Bank of England to raise rates. They have absolutely supply-driven inflation. And frankly, they're going to make a bad situation worse. Europe is headed towards a severe recession, and the Fed they are contributing.
So what do they do? I mean, we've got a Fed meeting November 2nd, and after that, let's have Claudia Sahm, market expert, come in here and give us a take. Are we way overdoing the parlor game out? Fed meeting 2, Fed meeting 3?
They need to slow down. They're not going to. I mean, 75 is absolutely happening. 75, 50, 25 would be great, but I don't know. I wouldn't be surprised at all for a 75-75.
Is currency of value to you here? I mean, to study strong dollar and all the different dynamics of pairs?
So what a strong dollar does is it means it's cheaper for us to import goods. And we like a lot of cheap goods from abroad. And right at this point, we are doing beggar thy neighbor. We are bringing in, with the strong dollar, we are importing disinflation and we are exporting inflation. And that's good for us. Yay, America. But that's not, if we push the global economy into a severe recession, we're not going to withstand that.
You come out of the Michigan Combine, which is massive inflation analysis, all the different professors and the wonderful Granick and all the rest of it. Which matters to you now, a services pullback or a goods pullback to disinflation or even outright goods deflation? Which of those two is more important?
Well, broadly, we say that the best cure for high inflation is high inflation, right? That consumers need to get price sensitive, they need to pull back. And we're seeing that there has been slowing in the growth of consumer spending. A rotation away from goods and back to services, it's going to be disruptive. Every rotation we see is disruptive. We need to get back to something that is a semblance of normal.
Lisa emails in and she says, would you ask Claudia here about what the inflation worriers are getting wrong? I mean, the inflationistas used to be Chuck Plosser in Philadelphia, and now the inflationistas are Larry and Dudley. Line them up like ducks. What do they get wrong right now?
Well, the Larry and Dudleys were right for the wrong reason this year. Last year when they were talking, it was all about the rescue plan. Well, COVID, Delta, and Omicron, and all the variants, and then Putin showed up, right? So if you don't get the story right for the right reason, you will make very bad forecasts. So their forecasts right now are just, set them to the side. The thing the Federal Reserve is doing is they are so afraid of these inflation expectations taking hold. Those expectations look solid. People believe the Fed is into fighting inflation, right? But they're now worried about, well, they're stable, but they could come unanchored and rise. And it's like, you really are going to tank the global economy over something we have no signs of? And when they move slowly, right? So it's just, that is their big fear right now. It's embedded inflation expectations.
You have cats at home. Your new cat, did you really name it Pivot?
No, she's Puffy.
Puffy, okay. Claudia Sam, thank you so much with Sam Consulting, and certainly one of our great experts in this nation of the measurement of a path to recession. We're going to continue sterling weekends. That is front and center. Futures negative 20. This is Bloomberg. Stay with us.
Keeping you up to date with news from around the world with The First Word, I'm Kaylee Lines. President Biden has started aggressively promoting his student debt relief plan. The government has been working out the kinks in the program, and a White House event Monday is set to officially launch an application website. But multiple legal challenges, including a lawsuit from Republican-led states, are moving through courts, threatening to halt the effort. Italy's Giorgia Meloni has clinched a mandate from her coalition on the path to becoming Italy's first female premier. The coalition, which includes her Brothers of Italy party, former Premier Silvio Berlusconi's party, and Matteo Salvini's Lega, told President Sergio Mattarella that she is their candidate. Mattarella is expected to formally ask her as early as Friday to form a government. China has locked down parts of a central city, confining some of its 13 million people to their homes for at least a week. Other major hubs are rolling out virus restrictions as well, reflecting the country's commitment to its COVID-0 policy. Residents in high-risk areas are required to stay at home until no new infections are reported for 7 days, and then they get moved to medium risk. Hong Kong officials have canceled a screening of a Batman film 1 year after passage of a law that lets them ban movies on national security grounds. It was a showing of the 2008 movie The Dark Knight, set for next week at an outdoor venue. A notice said the decision was, quote, based on direction from the Hong Kong Government Office for Film, Newspaper, and Article Administration. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lines. This is Bloomberg.
you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
I think inflation has reached the top. I think it is starting to come down. I think it may come down more slowly than people are hoping because of the stickiness in the shelter cost and the stickiness in labor markets. But as I said, I think the Fed has had a positive impact.
One of my favorite people, Jonathan Gray of Blackstone Group. If you are young and you make a lot of money, what do you do with it? And this guy, more than anyone I know on the island of Manhattan and the 5 boroughs, is ponying the money to charity. No one like Jonathan Gray. Great to hear from him with Shonali Basak here over what Blackstone's doing, particularly in real estate. Lisa, let's just take a moment here on that. This is a sensitive issue where in the modern age, fancy people with fancy money are cornering the real estate market in America. And that's part of the Blackstone questioning, if you will.
Well, and this has been the story for a number of years. Will they continue to be buyers as mortgage rates go up and prices come down? And also, how much are they going to raise rates at a time?
Raise rents.
Raise rents at a time when there is this increase, and yet there is popular antipathy toward this.
The future's negative 23. We're watching yields. Lisa stunned by a 1.78% real yield, and that folds into all of our investment calculations on a Friday.
We're seeing a macro move. Let's be very clear.
That's the best phrase of the day.
This is
macro
a
move.
macro move. Yields higher, dollar stronger, disrupting a lot of different trades. You're seeing that with the euro weakening. But again, this is a dollar story, 97.37 euro dollar cross. You could see this in the 10-year yield breaching the highest levels we've seen going back to 2007. Right. What does this do to reset valuations, to reset understandings, and how much further this has to go? Sebastian Gailey, senior macro strategist at Nordea Asset Management, joining us on a macro move. Sebastian, how durable do you see the moves of today, seeing new highs in yields, seeing new highs in the dollar versus certain asset classes, seeing the yen on the brink of unraveling?
Yeah, the interesting question is, in essence, can we predict how high the Fed has had to go when we don't understand the inflation dynamics very well? Over time, people have become more detailed, supply, demand side, looking rents, looking at the different subcomponents, analyzing the different stratification within the consumers. There are rich consumers, they don't care. There are middle income consumers, some of them do care, they're very leveraged. And the ones who are poor, obviously, you can't sell so much to target. Others have to basically are left with inventory of prices which they've overpriced. The margins are very, very, very high profit margins. And so we have this big demand which is coming in with supply, which is an issue, and eventually it slows down, led by the poor, but the middle income and the rich are still doing very well, and the message hasn't completely gone through that leverage is getting very expensive, that your real estate market is probably overly expensive. And so there's not yet the moment of doubt within US consumer where everything adjusts. And on the corporate side, also, some of the corporates remain in a delusion. They think everything is actually doing well. From CEO confidence indeed has fallen a lot, but it's probably led by the people who sell low profit margin type of products. The likes of Apple are a little bit worried they might fire 1,000 people, not very much more. And so we haven't seen that big adjustment both on the household side, on the corporate side. And when it happens brutally. And that's the issue. We don't know when it's going to happen. We don't know how much the Fed exactly has to tighten. It's probably already over tightening, but it has no choice.
How close are we, Sebastian, to something breaking in markets before they reach that point?
And if you look at equities broadly outside of the United States, they're actually quite cheap. So if you have to make a call as an asset allocator, you can say in the next 3 to 6 months, or let's say 3 to 5 months, is actually going to become very interesting for equity investors. From the US side, some of the stocks, NASDAQ and the likes, still remain very expensive. There's still this belief in America being a great economy, well-managed economy, and being just a great place to invest. And it's not only for Americans, but pretty much everyone else around the world. And it's part of the reason why the dollar is so strong.
Yeah. Sebastian, you wrote a brilliant essay of optimism on the United Kingdom. You said to compare and contrast with Italy is wrong, wrong, wrong. Explain to us your optimism as the United Kingdom extracts itself from political crisis.
And so one of the reasons you can get political instability is because you pander to simply one group within that population and not the entire population. And UK has a long history of basically being well governed, and we've seen significant accidents recently. But in general, they just know how to do the right thing, both from the Labour side and from the Conservative side, not always immediately, but eventually. And so there's a sense that there's a social contract in the United Kingdom, as you can see it also all around Europe, not everywhere around Europe, and also to some extent in the United States. It means that people believe that the Bank of England will eventually do the necessary. The government eventually does it. And Mrs. Truss actually resigned. Nobody pressured her. She was under significant pressure, but she did it by herself. So she considered, okay, this is not good for the country. I will step aside. It doesn't happen in many countries.
I got a day trade through to Monday. Am I going to go long sterling here, Sebastian? Help me.
What you want to do in FX in general, preferably is avoid it. I have long experience as a currency strategist. What you do want is stay on a long dollar position, but it's becoming increasingly dangerous both on the dollar yen side and dollar versus emerging market. We're seeing the renminbi weaken consistently on the back of one must be recession in China, and so it's a difficult and unfortunately complex environment. The long dollar story probably still has some legs, but it's becoming very dangerous.
Sebastian, thank you so much. Terrific Friday brief. Sebastian Gelli, always better on Friday when in Nordea Asset Management is, well, you know, Lisa, I use this word too much, but the swirl that we've been through, not only this week, but the month, or maybe it's 8 weeks. I lose track here in this forever long 2022. I look at the screen and all I can hang on is the inflation adjusted yield. That's what every guest is focused on.
And to be very clear, because people will say real yields are still very negative. They're not actually positive if you look at where inflation is now. This is for what people are gaming out in markets for inflation over the next 10 years. So that means that people think that the Federal Reserve is going to raise rates by the most above where that inflation rate is expected to be over the next 10 years, going back to 2009. How much, though, does this talk about what we've been discussing for a long time? People keep getting it wrong with inflation, and we don't understand why. The lack of certainty around what the main drivers are and the stickiness of this. I mean, Philadelphia Fed President Patrick Harker yesterday.
What did he say?
He said that the Fed's anti-inflation policies are, quote, frankly disappointing. And he talked about how he expects the yields to be, Fed funds rates to be well over 4% by year end. This is the base case.
Yeah, but to me, it's not the level of what the yield is doing. It's going to be the length of that. And the major message I have out of IMF meetings and all that's going on right now is transitory is just gone. There's no other way to put it. And we're getting comfortable with yields from 30 and 40 and 50 years ago, which leads me into my great theme, I think, for next year, which is the great zombie roll-up. What do you do? What do you do in tech if you're in a non-profitable company? How do you drive that forward?
You're seeing it certainly in the share prices. Did you see Snap? I mean,
Yeah,
it lost
well,
a quarter
I got
of its
off
value
Snap and
after.
TikTok, and look what they did.
Well, yeah, exactly. It's all because of you, Tom. It's, you know, if only you would endorse that. All of these companies that you're seeing that really blew up during the pandemic and expanded have been deflating bubbles over the past couple of months and just continue to be so.
113 DXY, the yen, a 151.34 is newsmaking through your weekend to the Asian Sunday morning. Stay with us. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
No one covers the world like Bloomberg.
Because Trustonomics is being dismantled, MPs behind the scenes are asking what's the point of having her at the top?
Can the strong dollar amplify the world's risks of instability?
Xi Jinping said complete reunification must be realized.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
We're probably going to see persistent inflation, and that these yields are not all overdone.
The real worry is not only about this winter shortages, but also next winter shortages.
We have an almost abnormal obsession with all things inflation. For the most part, what we're seeing is the consumer's okay.
People continue to have a pretty high cash coffer.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Bramwitz, and Tom Keene on a Friday on radio, on television. And what you need to know, well, we're going to go to Tom McKenzie at Parliament on the Derby in the United Kingdom. It is an odd Friday in the United Kingdom after the history that we saw yesterday. We are going to try to steer through the next 2 hours. Steve Major to join us with HSBC here on yields. Lisa, it has been secondary this week. It deserves, as you say, to be the macro story. The 10-year real yield can't get out of its way, 1.78%.
Bond markets are taking charge in a global economy and the global political regime that I could arguably say, given what happened in the UK. How much does this really tie the hands of fiscal policymakers that have gotten used to central bankers that will buy their bonds and bond markets that will give them cheap financing at a time where yields are surging to the highest levels in more than a decade?
And surging is the right word. I mean, as we go into the jobs report, as we go into November 2nd and a Fed meeting, the answer is there's a dynamic here into that meeting we didn't see 2-3 weeks ago.
And part of this is driven by that tension that we were parsing out with Claudia Sahm, this idea of the Fed is moving further than people had imagined they ever would or could, simply because we have been surprised again and again with the inflationary impulse and how durable it is and how strong it is. And it's not just the U.S., it's Canada, it's the United Kingdom, it's the European region.
You know, I look here at the Bloomberg Index, and this is the blend, folks, that you see on the Bloomberg Total Return Index. There's like 8 or 9, 10 of them, and there's one that you center on, negative 18% in widening out every day, a price decline in bonds.
And a price decline that people are saying is resetting yields to a level where they're sort of becoming attractive, but the marginal buyer is not yet coming in. And I know that you have your thoughts on that. But how much is this a reset, to your point about how long rates remain at this level? A reset in corporate America, in the global corporate sphere, with roll-ups, with potentially companies going bankrupt.
Yeah.
Right now, we're not seeing that price into the market. And earnings have held in, at least for the most part.
Sunday night, Phillies, Padres, maybe. Yankees, Astros, maybe. Ministry of Finance, maybe.
Exactly.
We may get in our Sunday night at 151 on yen. Maybe we need to pay attention.
I know, right? 151 climbing in terms of the dollar versus the yen. And at what point do they step in? What's the line in the sand, right? People were saying it was 150.
You got me.
Surged through that. They before said it was 145. We're well past that. And how much do we keep going? And are they just simply going to try to control the pace of the deterioration, of the weakening in the yen versus the dollar versus outright support it?
On Friday, not that many earnings on Friday. American Express comes in with a report. We'll go over it in 2 seconds here. Revenue up 23%. It was supposed to be up 25%. I mean, that's what their view is. Those seem like ginormous numbers, and yet it trades off a little bit here. They see their forward guidance is not so
Yeah,
forward.
the full year earnings per share is estimated to be $9.25 to $9.65. The estimate was $9.90. This is actually really quite important, given this could be a bellwether on wealthier individual spending, and whether they could be cutting back as well. I don't know. We haven't seen it in the
The acclaimed Bloomberg headlines on American Express. Here's one. American Express haven't seen changes in consumer spending. And the next headline is, Redo keeper of the Amex says Tom stopped spending. So there's some of the granularity that you've got. Data. Let's do it right now before the brief. Futures negative 17, Dow futures negative 100. The VIX critically above 30. The VIX has gone nowhere this week. That in itself is a story. The curve inversion a little bit less, in that 10-year real yield 1.77% on dollar strength. Lisa?
Yeah, we are looking also at a slew of Fed speak, and I really do have to harp on this Patrick Harker comment yesterday about how it's disappointing how the Fed tightening has worked so far and where the CPI has come in. We do hear from John Williams, New York Fed President, 9:10. Charlie Evans is expected to speak, Chicago Fed President, at 9:40 a.m. Also today, earnings. We did just touch on American Express, which just came out in about a half an hour. We'll get Verizon Communications. It's been hit or miss, right? It has not been consistent. We have about a quarter of the earnings coming in at this point, and it's really been hit or miss. American Express missing to me is very interesting. I'm curious to parse through and understand, okay, if their spending habits aren't changing, why is revenue coming in light?
What I don't get here, Verizon, 10-year total return per year, 2.83%. I don't know what to do with that.
Well, but this was what we were talking about yesterday. Utilities have been chugging in at less than junk bonds in terms of the returns. Does that change? I mean, how many people have come on this show and said utilities are the place to be because they're havens, they haven't been bid up, they haven't done the snap thing? All right, we're also going to be hearing from European leaders today, and this to me is something I am just sort of keeping an eye on. This is the second day of a summit in Brussels, talking about price caps, talking about what to do with the energy crisis. I know.
What's important about this? Seriously, explain for our American audience, what's the so what of Brussels this morning?
Two things. Number one, I want to see what they have to say about Liz Truss's resignation and where the bond markets have been pricing different plans to try to address the energy crisis. And then I want to understand, okay, crisis over, we see natural gas prices in Europe plunging on the likelihood that they have higher stores. So what do they have planned for the winter after? How about the winter after that?
Okay, Tom McKenzie here in a bit will give us an update from Parliament. Right now, your conversation of the day of a diversified portfolio. Sarah Hunt joins us, portfolio manager at Alpine Saxon Woods. We'd love to have her on with the linkage here of all the media babble into what do you actually do in the equity market. Sarah, how much cash do you hold right now?
I would say that we're holding higher than normal cash levels. So if normal is somewhere between 0 and 5, maybe you're closer to 5 to 10 or in some cases over that. I think that this is a very difficult time in the equity markets. As we've seen, the volatility has just been much wider than expected. And we have had the markets come down in multiple compression before we really get an earnings reset. And I think that's the biggest issue going forward, besides what the Fed is doing. It's the earnings reset. And we haven't really seen that yet. And I think it's coming.
And given that you think it's coming and other people do too, I wonder how much Chris Harvey really was ahead of the curve yesterday when he was saying that he downgraded banks to neutral from overweight, even after they just reported better than expected earnings, because it offered a pop in the market that gave him a good exit point. How much are you looking at earnings to basically cash in or out of the sectors that you don't like on some sort of strategic level, regardless of what the earnings actually said?
Well, I think what we're looking for on the earnings side is more consistency than trying to cash in or cash out. I mean, I think the banks have a tough road ahead of them, just given the fact that you still have an inverted yield curve. And so I think that as much as they've had good numbers so far, I think that that is why people are a little bit concerned about them going forward. I think that the hard thing is you just look at every different piece of this market and you're getting some good news and some bad news. Like UNP said that they're worried about stuff. CSX said they weren't as worried about going forward carloads. So I think that there's just a lot of uncertainty between companies and everybody else right now. And I think that I just don't see how S&P, which consensus has higher next year, I don't see how that doesn't have to change before we start to get more comfortable with where equity valuations are, because the multiple compression has happened, but the E is still expected to be higher next year than it is this year.
Let's just put a bow on that, Sarah. Does this earnings season so far make you more or less bullish on riskier assets in the months to come?
I don't think it does either. I think really, I mean, this goes back to what are you looking for? We're looking for companies that can both grow their dividends and have some consistent earnings power, that through different cycles. I mean, I think that this earnings season isn't really changing that. The fact that Adidas just came in after Nike with bad numbers and everyone's saying the consumer is so great, I think there's just a huge disparity in what's going on in different places where people are spending. And I think it's really hard to game that out ahead of time and think that you know exactly where you're going to be correct.
Sarah, it's a new territory in that we're going to some form of risk-free rate. A lot of really good conversation on this show about the new regime for equities. What does the Sarah Hunt new regime look like if you get an actual real yield, an actual risk-free rate?
Well, you guys have talked a lot about on this show about the fact that it's hard to price risky assets when you're still repricing the risk-free rate, right? So that's part of what some of the volatility is about right now. I think historically speaking, it's not unusual to have rates maybe not in the 5 to 6% range, but maybe in the 3 to 4% range. And I think that there will be an adjustment to that. And part of that adjustment has been the multiple compression that we've seen so far. The problem on top of that is that we are probably facing recession if we're not already in one now. And we certainly are concerned about global growth, and not just U.S. growth, but growth everywhere. And I think that part of that, you've got energy prices that are problematic. You've got food prices that are problematic. Right. Some of that on the back of Russia, Ukraine. There's a lot going on.
So I just need some advice. Do I buy Apple this morning?
We like Apple. I think that the market gives you opportunities to pick everything up a little bit cheaper, and this is what we've seen so far. So there's a lot of stocks that we like. I think of Apple's more of a staple than a tech company because nobody can live without their phones or their iPads. No. I think that there are some places in the tech world that we like. Right. And still, the whole group is being sold together for the most part, although Apple has held in better than a lot of its compatriots.
There's your banner this morning. Hunt, Apple is a staple. Sarah Hunt, thank you so much. Alpine Sachs and Woods as well. Let's digress to tech chat right now. Yeah. At your house, do various offspring have lined up the next Apple item that needs to be bought?
No, in my household,
I think I'm like 4 out.
Seriously, they have antiquated tech that they sort of line up and have multiple screens in front of their.
Come with a vengeance.
Yeah, no, but it's funny. They have like 5 screens and they kind of switch from screen to screen. I'm basically a fantastic mother, as you can tell.
I can tell.
But
it's abuse.
Basically,
it's amazing. This is really important actually with all the the macro babble we do. Some of these stocks are staples like toothpaste.
Yeah, although you possibly aren't buying as many upgrades if the kids can actually go outside and play with their friends rather than during the pandemic where they couldn't. I'm just saying that, now there is an alternative and you can kind of say, guys, get off the screens.
Go out and play.
Then they can say, no, we don't want to.
Remember that?
You can try really hard. And anyway, I'm digressing.
Dollar strong, you're just going down in flames. Steve Major in the next hour. Stay with us. Dollar stronger. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Kriti Gupta. Ukraine's foreign minister says he talked with Israel's prime minister about Kiev's request for defense systems to help combat Russian missiles and Iranian-made drones. Israel has offered to assist Ukraine with a missile warning system, but says it will not provide weapons. The U.S. has accused Tehran of sending trainers and technicians to Crimea to support Russian drone attacks. And the European Union has agreed to press ahead with a set of emergency actions to address the bloc's energy crisis. It comes after Germany yielded to pressure from other member states to pave the way for a temporary price cap on natural gas. The European Council's president says the move sends a clear signal to the market that the bloc is ready to act together. The Biden administration's officials are said to be discussing whether the U.S. should subject some of Elon Musk's ventures to national security reviews. Sources say that would include the Twitter deal and SpaceX's Starlink network. U.S. officials are uncomfortable with what they see as Musk's increasingly Russia-friendly stance and his plans to buy Twitter with foreign investors. Credit Suisse will aim to settle a tax fraud and money laundering case in France on Monday. The Swiss lender is reportedly in the final stretch of negotiations with prosecutors to reach an agreement that would include a fine but no admission of guilt. The size of the settlement is unknown, and the deal could still fall apart ahead of the court hearing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kriti Gupta. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are on Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts, great questions. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Britain in crisis.
I am resigning as leader of the Conservative Party.
The shortest ever serving prime minister.
Trust Bloomberg for the fastest coverage and instant expert analysis.
Is a general election enough to begin to restore some of the credibility?
It takes a long, long time for the markets to forgive you.
You are now, from an economic point of view, tinkering.
Brexit has not gone away.
Wake-up call here for the Conservative Party.
For continuing coverage, keep it tuned to Bloomberg Television and Radio.
We fixed a high threshold, but a threshold that should be achievable by any serious candidate who has a realistic prospect of going through. A threshold of 100 members of Parliament nominating a candidate obviously allows for 3 candidates potentially to come forward.
Graham Beatty for the Conservative Party. The Minister Brady is the one making the rules. Maybe he's like the head referee at the NFL games this weekend. We welcome all of you on radio and television to a most interesting Friday. John Farrow's off. Lisa and I are really trying to focus on bonds, on stronger dollar, on yen weaker, rounded up. A 152 yen is stunning. But yes, even we on this Friday must turn to the United Kingdom. And we do so. The movable feast now's BBC just has the esteemed Defense Secretary, Ben Wallace. He will not run. And I think the major message for Americans on this Friday is, don't we wish in America we had the timeline of this race? Wouldn't it be great to have a midterm election or presidential cycle that goes to 9 a.m. on Monday?
It is 9 a.m. Monday. We're going to find out our time, what happens in terms of leadership. I don't think that anyone in the UK would say they're in an enviable position right now in terms of some of the tumult. We do, of course, though, think that we have an enviable position in terms of our bench of people who have been covering this. Tom McKenzie right now at Westminster of our Bloomberg here. And I'm wondering, Tom, you're watching all of the MPs come out with flags saying who that they're going to vote for. Who's the front runner right now?
Well, the front runner remains Rishi Sunak, of course, the former Chancellor, but also the person who triggered, of course, that pushback that eventually led to Boris Johnson being forced out, and that has alienated him amongst large swathes of this Conservative Party. So we're looking at the Daily Telegraph, that is the Conservative leading newspaper. They're quite well sourced. They've come out with around 48 MPs now backing Sunak, 37, though, for Boris Johnson, and 16 for Penny Mordaunt. Worth reminding viewers, none of these three candidates have officially confirmed that they are, in fact, running. But that's where we are in this. We are monitoring the number of MPs coming out, putting their names behind these candidates. And as you said, we could have a new Prime Minister, a new leader of the Tory party and a new Prime Minister of the United Kingdom as soon as the end of play Monday. The first ballot, as you said, 9 a.m. US time, 2 p.m. UK time. The official deadline, they have to have chosen someone by Friday the 28th.
It feels like there's somewhat of an existential question behind this. How much authority the new Prime Minister will have coming in, given the diminished influence of the Tory party, given the black mark of Liz Truss. What's your view on that?
Well, these are politicians now with policies that are being policed by the markets, and that has just been made ever clearer. You're seeing the volatility again with the pound under pressure today and yields up. They now know, even the orthodox or unorthodox members of this Conservative Party now know that their policies will be closely scrutinised by the markets. And so to that extent, there are the guardrails around the policy making. But then there are the polls that they have to contend with as well that show an historic lead for the opposition Labour Party. Yes, we are officially 2 years out from an election, but to what extent can you push through policy when you are divided in your domestic party and you're facing the kind of pressure from voters when it comes to the polls as you look ahead to those potential elections?
Tom, the Sunak-Johnson animosity, is it a personal thing? Is it, heaven forbid, actual political theory they disagree on? Color this, not hatred, that's too strong a word, but color the political reality these two face.
So I was speaking to the former strategist for Boris Johnson earlier this morning. He said this is a personal dispute. They dislike each other personally. There was the tension leading up to, of course, the ousting of Boris Johnson. In terms of the policy agenda and the framework, well, this former strategist for Boris Johnson said he doesn't really have an ideology. Rishi Sunak does. He's been proven right around the market reaction to this mini-budget unfunded tax cuts. So in that respect, he has credibility with the market, and he has support with at least some factions of the Conservative Party, but he is also, the former Chancellor, deeply alienated those parts of the party, those members of Parliament, but also grassroots supporters of the Conservative Party who continue to support Boris Johnson. So the idea that these two would serve together is very unlikely at this point. The other question is, if Boris Johnson does win this, what happens to the current Chancellor, who has done and made some progress in restoring some of that credibility?
That's right where I wanted to go. Just to wrap up here, Tom, and my head is spinning on this, folks.
Yeah.
Johnson, who's his chancellor? Sunak, who's his chancellor? What's the game on that right now?
Boris Johnson and his chancellor, frankly, very, very difficult to say. You can say that he's going to rule out Rishi Sunak. Absolutely.
Yeah, okay.
Does he stick with Jeremy Hunt? Possibly. There is some animosity on that front. Rishi Sunak wins this. He's currently leading with more MPs backing him. A long way to go, of course, until that Monday ballot. Who does he choose to be his chancellor? Possibly someone from the right of the party to try and close that division.
My deepest sympathies. Tom McKenzie, thank you so much with coverage in this absolute chaos in the United Kingdom. And Lisa, seriously, to their great credit, after the whatever it was, 7 weeks ago, 6 weeks ago, whatever it was, the madness, the timeline here is just shockingly short. A week from today, they're going to have a prime minister. I think Monday, 2 p.m. their time, we're going to get a real clarity on that. And I don't know what happens between Monday and Friday.
What Tom said there was really prescient, I think, also. The markets are in control here, that basically any Conservative member who comes into the office is going to have to run their policies by the market, essentially, to see whether there is enough stability in the response, whether bond yields don't climb dramatically, whether you don't have a further sell-off in the pound before they are ratified by the public. This really calls into focus this question about how tenuous right now the political system is at a time when there is historically low popularity for the Tory party.
No, but to sum this, the vigilantes are tangible. I mean, there's the bond vigilantes, there's the FX vigilantes, and there's the Bank of England vigilantes. I mean, I don't even understand where Governor Bailey fits into this.
Well, there's going to be increasing pressure, and there has been already, to possibly pull back with some of the rate hikes, saying, look, we've got your back with the fiscal policy. We're not going to be spending a ton of money. So at what point does that become a problem for markets as well, right? You don't have a candidate who can actually call into question.
Bring that over to the Fed. I'm going to bring up the FOMC screen on the Bloomberg November 2, December 14, and I click the little thingy here, and I go out to a long ways away from December 14th, February 1, and on to March 22. Where are we March 22nd of next year?
Well,
I have no clue.
The market's saying 5%, and it's saying that we're going to stay there for quite a while. And that, to me, is sort of a sea change, given where we had been.
Massive. What does that do to dollar?
I mean, that's what you're seeing. Well, you're seeing it do to dollar, right? I mean, you're seeing it strengthen against absolutely everything, and torpedo right now, the end.
The team coming off of yesterday's festivities and fireworks in the United Kingdom. A great lineup today. Leslie Falconio will join us. Stephen Major of HSBC in the 8 o'clock hours. Stay with us on this Friday. Good morning.
make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Bloomberg surveillance movers coming up. One of the movers is the government of the United Kingdom. Lisa will have that
Well
for
done,
you
Tom.
in a moment. John Farrow is off. We've had hundreds of emails today. What's the likelihood of a Farrow sighting Monday? And I'm really not sure.
It depends on whether there's a sighting of a new prime minister.
I think it is. It's hinged on the new prime minister as well. John Farrow will be with us, I believe, back on
He'll be
Monday.
back, yes.
I talked to him yesterday at length, actually, and he was following the festivities in his disunited kingdom. Thanks to Tom McKenzie at Parliament this morning. We'll have much more reporting on this. This is a movable feast, folks, for the morning. Stay with Bloomberg Radio and Bloomberg Television. Ben Wallace, the Secretary of Defense, I'm using that as an American phrase, in the United Kingdom has just ruled himself out from running. Futures negative 13, Dow futures negative 104, VIX 30, but actually a little more constructive. Oil doesn't give me much love this morning. Currency, stronger dollar. Yen is the story. Watch it through the weekend to their morning, a 151, 152 on yen. Sterling took a run to 110, weaker, 111.27. Market movers. Lisa.
Thanks, Tom, for that. I've been looking at the big tech names, which we were talking about earlier.
Next week,
and
right?
We get the big tech on Thursday, the sort of Amazon behemoths and the Apple. But we got Snap, and Snapchat's been on a downward trend pretty significantly, and it is down by more than 25%, now down more than 27% after reporting its slowest quarterly sales growth ever. They missed their estimates. How much does this really speak to a problem in the broader ad-driven tech world? And this is the reason why you're seeing some of the other names sell off in sympathy. Meta, among them, down almost 3.6%. Google, or Alphabet, the parent company, down 1.7%. Again, this speaks to why advertise if you, A, don't have the goods to sell, which actually isn't the case anymore if we talk about inventories, but B, if you really don't see the same kind of revenues and your margins are getting cramped and you need to really right-size and figure out the business plan ahead. Talking about right-sizing Twitter, there were reports overnight that if Elon Musk comes out and does buy this company, he plans to cut the staff by 75%. Those shares down by 7%, not because of that, but because this morning, Bloomberg's reporting that U.S. officials are questioning the deal and investigating some of the ins and outs of Elon Musk and what he's done.
I read this wonderful reporting from Bloomberg, from Jennifer and the team at Bloomberg. And first of all, this is really serious, really original.
Agreed.
Here's a guy who gave technology to Ukraine. Great. And I don't know the details of that, and I don't have an opinion on that. But this transaction may be held up because that's like a Department of Defense national security thing.
But it highlights Elon Musk as a polarizing figure and someone who really skirts the edges of compliance, the edges of what's okay, including on Twitter. And so how much does this really affect the likelihood of him taking over? And then what does that say about all the job cuts? Because even before he was planning to take over, they had planned cuts for that staff.
Right now, Verizon out. It looks okay. They're going to, quote, start cost savings plan.
Yeah, read job cuts.
Yeah, thank you.
I mean, that's basically it. Oh, can I just say one other thing? You know, when I was confessing...
Can she say one other thing? Okay, go.
Okay, thanks. When I was confessing my terrible parenting, someone, a viewer who begged me not to be named, said, in our house, we have had to use going outside and playing with your friends as a punishment for not doing your chores. You are not alone. I love that. That really, I think I should use that.
These kids today.
These kids today.
What can we say? What we can say is to speak to Leslie Falconio, head of U.S. Fixed Income Asset Allocation at UBS Wealth Management. Leslie, thank you so much for joining us. And so much of this is the readjustment to the news flow we're seeing. Are you into a year ahead review yet, or are you still trying to get through the fourth quarter?
Well, we're in a little bit of both. You know, I think that we're trying to understand the fourth quarter to really project the year ahead. And I think that one of the interesting things is as we look at what's happening in terms of this fourth quarter and how we enter 2023 is that we're seeing these yields in the 10-year that we haven't seen since, 2007. You have a large correction, particularly in fixed income, and mostly due to the rise in interest rates, will really set the tone for next year.
They're going to set the tone for next year, and it's a yield structure back from another time in place. Does that change your equity allocation or the factors that matter in equity that you finally have a risk-free yield?
Well, I think, as a fixed income person, I look, very closely at the risk-free yield and what you're being offered in terms of equity versus fixed income and how much that risk-free rate has risen and whether or not, whether it's high yield or equity, investors are compensated by that risk premium, given that we have seen this rise in interest rates. And overall, in our opinion, I think the fixed income market is a bit ahead of the equity market, particularly the U.S. equity market. And there's pockets of vulnerability that we're seeing that really haven't adjusted in terms of risk premium. When we think of sectors such as high yield, high yield has been incredibly resilient this year. At the spreads of 490 or 500, you're maybe at the median right. Spread. So, we don't think that going forward, what investors need to look at is really where the underperformance has come from, mostly has been a rise in yield, and whether or not you're really being compensated in terms of your risk premium.
Brilliant. And Lisa, this is to the heart of what you've been talking about, with some parts of credit have moved and other parts have shocked by the lack of movement.
Especially in the riskier segments, the more leveraged companies that are hanging in there because they are less rate sensitive. So let's move that into some sort of investment thesis. I mean, one of the biggest consensus trades that I've heard of recently is investment grade bonds. So many people love investment grade bonds because they have sold off dramatically, yields at the highest levels going back to 2009, and yet yields keep rising. What gives?
Well, I think, the yields keep rising because interest rates keep rising.
But spreads too.
Spreads as well, yes. And I think the difference between, say, like high yield and investment grade corporates, and by the way, we think high yield is very rich to investment grade right now, both fundamentally are at a situation where they have very low leverage, high interest coverage. But as the Fed raises rates and you have this borrowing cost that's going to stay higher for a long period of time, particularly during a period next year when growth will be slowing, you really have to assess which sector you want to be in and where you're being compensated for that potential pocket of vulnerability. And we do think that IG, given the fact that it's widened out a bit because it's seen much more supply, offers much more value than high yield here.
So right now, are you basically really going into longer term treasuries and some of the higher quality investment grade names and just locking it in and saying, if we can get 6% yields, which is what you're getting on average in the investment grade space, well, hallelujah, let's hang on here for the next 3 years and we're going to look great.
Well, I think what you just said is very important the next 3 years. And I think you have to look at, value versus timing. And look, as we know, this is not the most liquid market, and there's a tremendous amount of volatility. And we are getting incrementally longer, meaning we're adding a bit of interest rate risk incrementally, but we are in the fourth quarter. We do believe 6 months from now, yields will be coming down, and that, the opportunities we're seeing today, particularly on the yield and rate side, will actually be a tailwind to performance next year. But in the short term, you're going to have some volatility. But the yields that we're seeing here in both, whether it's investment grade corporates or agency mortgage-backed securities, and the spreads, we haven't seen them, in probably about 10 years.
We're just talking about the U.S. here. What about the United Kingdom? Are you buying that dip?
Well, the UK is a little bit, in our opinion, I think a little bit too volatile. I think there's a lot still happening in terms of the UK, in terms of a falling knife that you might not want to step in front of. There's a lot of issues that may have been resolved, but we do think they're going to be a bit more of contagion in terms of the potential recession in Europe, and the volatility there is a bit too high.
See, I want to back up and just look at the carnage that's out there for many clients, and not just UBS Global Wealth Management. It's been a group effort to see price down and yield up. How do your clients who have a 10%, 15, dare I say, 18% loss in fixed income, how do they respond to the idea of reallocation and making a new go of it?
Well, look, there's no question. The performance in fixed income, the double-digit negative total returns has been very visibly displeasing. But, the purpose of fixed income is income. And you finally have a wider opportunity set that we haven't seen in years to compound that income going forward. Particularly if you're an investor that holds to maturity, you're getting prices that are well at a discount. You'll move up to that par level and earn that incremental total return. And it's still an important part of a portfolio, particularly as a diversifier. And again, when we think about the magnitude of rates that we've seen in 2022, we don't expect to see the same magnitude in 2023.
Leslie Falcone, thank you so much with UBS this morning. Lisa, I want to go to your wheelhouse here, and it's on this idea that high yield maybe hasn't deteriorated like the others. And folks, you can see these in fabulous indices at Bloomberg. This is, of course, all the legacy of Lehman and Barclay. Now with Bloomberg, our total return indices are really informative, particularly when you look across a set of them. And the high yield one hasn't moved like the other ones. So when I say to you, Lisa, the zombie roll-up, which is easy in equities, What does a zombie roll-up look like in distressed debt?
It's unclear because, and this is actually a debate I've been going back and forth with a number of different investors, why has high yield remained so intact given the pain that we've seen in investment grade debt? And there's an argument, well, it's less rate sensitive, but it's also on the spread side. And then people say, well, they're better capitalized, they're better rated, and they have longer maturities. And oh yeah, the oil sector is doing great, and the energy sector is a significant portion of it. So that's the other argument. But then you have all the people who flood in, just like Leslie Falconio just said, and said they're just getting it wrong, right? And so then that leads to the question of, well, then what does this credit cycle look like if you don't have a Fed that's going to come to the rescue? And if you do see yields, baseline rates go to 5%, and this is your point, Tom, and this is a good point, and stay there for a longer period of time.
I mean, I just brought up, you can do this, folks, on the Bloomberg. I'm like the worst person in the building on this, but I'm enjoying the Snap 5-year, 4-year out, 6 years out convertible bond. And I'm enjoying that, Lisa, from 100 down to 69. It's down 30%.
Yeah, I mean, it's been dramatic, but...
I mean, people don't talk enough about the price decline in some of these single bond securities.
Although you could argue, even with that huge price decline, we haven't seen the forced selling. So you haven't seen the really dramatic dislocations that would either cause the Fed to come in or would cause people to be able to buy truly on a discount fire sale. So, you know, is this really as bad as it gets, right? And this is what some people are saying.
No. As bad as it gets is a 98-year Austrian bond Farrell got me into. We'll look at that in a moment. This is Bloomberg. Stay with us.
Keeping you up to date with news from around the world with The First Word, I'm Kriti Gupta. President Biden has started aggressively promoting his student debt relief plan. The government has been working out kinks in the program. A White House event Monday is set to officially launch an application website. Meanwhile, multiple legal challenges, including a lawsuit from Republican-led states, are moving through courts threatening to halt the effort. Italy's Giorgia Meloni has clinched a mandate from her coalition on the path to becoming Italy's first female premier. The coalition, which includes her Brothers of Italy party, former Premier Silvio Berlusconi's party, and Matteo Salvini's League, told President Sergio Mattarella that she is their candidate. Mattarella is expected to formally ask her as early as Friday to try to form a government. China has locked down parts of a central city, confining some of its 13 million people to their homes for at least a week. Other major hubs are rolling out virus restrictions as well, reflecting the country's commitment to its COVID-0 policy. Residents in high-risk areas are required to stay at home until no new infections are reported for 7 days, and they get moved to medium risk. Hong Kong officials have canceled a screening of a Batman film 1 year after passage of a law that lets them ban movies on national security grounds. It was a showing of the 2008 movie The Dark Knight, set for next week at an outdoor venue. A notice said the decision was, quote, based on a direction from the Hong Kong Government Office for Film, Newspaper, and Article Administration. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries worldwide. I'm Kriti Gupta. This is Bloomberg.
somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
When U.S. inflation numbers are released,
the score is inflation won, Fed nothing today.
Bloomberg brings you crucial data at terminal speed.
Core CPI in America, 40-year high.
Yields are absolutely flying.
Equities down and down hard.
It's ugly.
And instant expert analysis.
What is the makeup of this inflation?
We are watching the underlying fundamentals.
Will they go 100 basis points?
The downshift just keeps getting pushed out. Now it looks like we're going into extra innings.
Nobody covers the economy like Bloomberg, your global business authority.
What you saw Trust do, very much linked to what Quartain did, was to essentially try and blow up the markets. I mean, there was no possible way of having these enormous unfunded policies. The markets simply couldn't sustain them.
The professor from Dartmouth, David Blanchflower, was with us not once but twice yesterday, and we really thank him for his perspective here on his Bank of England and, of course, on the political uncertainties in London. Right now, 4 or 5 movable feasts, and we had to look at 2 or 3 and push them aside by a single headline from the White House. This is according to Bloomberg News. White House not aware of national security review for Musk Ventures. And Lisa, this has to be Twitter, and I guess we'll have more on that coming up here.
Yeah, and we are seeing the shares pull back from some of their earlier declines, down only 3.5%. I will just note this, that our own Jennifer Jacobs had tweeted the story out, and somebody responded, it would be hysterical if the government stopped Elon from overpaying for Twitter. And then Elon Musk responded to that saying 100% with a laughing, crying emoji. So that was, his technical response to that.
My distant view is price to sales. It's ugly. Also is sterling. It was a weaker sterling through the tumult of the morning. It has rebounded in the last 1 hour, and suddenly, as Caleb Pickering was wired up, Lisa, sterling's rolling over. We're not through a 111 yet. We'll have a headline on that when we see it.
Meanwhile, the earnings very much bleeding into the forward economic view. American Express just recently coming out missing and saying that they built more for charge-offs, more provisions, and they increased their expected charge-off rate going forward. Caleb Pickering joining us, senior economist at Bloomberg. Given how quickly things are moving, how much are markets getting ahead of themselves with respect to how high rates this market can handle, this economy can handle, and how pervasive this inflationary push really is?
That's a good question. I am actually wondering at the moment whether the bond market and the equity market are worried about different risks, and these risks are mutually exclusive. So the equity market is now starting to panic about the squeeze in earnings and the loss of pricing power and weaker demand. The bond market still seems to be telling us that we've got more inflation and interest rate risk to worry about. Those are mutually exclusive events. If we get the loss of pricing power, then we don't have to worry about inflation into next year. And so I think it's more likely that the equity market is actually calling this right than the bond market, in which case we should be anticipating when central banks pivot quite soon.
All right, so this comes at a time when the bond vigilantes are back in force, and from London there at Berenberg, you have a good view into that and just how violent that response can be. Yep. Can the central banks afford to pivot, given how jumpy bond markets are, whether or not they're right?
Yep. I think that's a really interesting way to look at this, because it probably means central banks cognizant of this and don't want to go through the UK experience where all of a sudden bond markets really start to panic and throw up rates by, multiple tenths of a percentage point over the course of a day. You don't want that situation to happen. And so as a central bank, you may be inclined actually to go a little bit further than you need to. You might need clear evidence of disinflation, that you're in recession, which probably means, I think, Europe, we're getting there quite soon. US probably needs to run into next year.
Callum, Berenberg has just a fabulous team with Mickey Levy in America and Holger Schmieding with his brilliant continental view. Let me take you in the United Kingdom. Is the surprise forward not from the Fed, but a blink from the ECB that has a war going on?
The ECB doesn't have the same inflation problem to deal with that the US has. The US has a strong demand underpinning. The prices are rising and they're broad-based. In Europe, continental Europe, it's mainly this energy supply issue. To the extent that Europe is in recession now, we're seeing evidence of weaker demand. Really, the ECB just needs to keep raising interest rates until inflation peaks. Once that happens and they start to see those base effects roll over, you can start to take out some of the fear and you can hold rates. So I think we're probably quite close. I don't think we get close to 3% in the Eurozone. That would be more than enough, whereas the Fed probably needs to go substantially above that.
We're all focused on politics here, and certainly the zeitgeist yesterday was the separation of economics and politics in your United Kingdom. I don't buy it for a minute. How does Governor Bailey respond to a nation staggering to 2 p.m. Monday afternoon?
Well, at the moment, there's nothing for the Bank of England to do. We had the announcement earlier this week that active QT would begin towards the end of this year. The next Bank of England meeting to focus on is the 3rd of November. By that time, the Bank of England will know who the Prime Minister is and what kind of fiscal policies the UK will be pursuing over the medium term. The problem the Bank of England has got, after what we've seen, all of the noise, the bond market reaction, it probably needs to meet market expectations in the next meeting. 100 basis points is probably what we get, which will be a doubling of the rate hike in September. But I think after that, maybe 50 more basis points in December, and then the Bank of England's probably going to be done. By early next year, it's going to be so obvious that the UK is in a recession and it's disinflationary, and that you won't need to go any further.
So the Berenberg call on sterling right now as we near a 110 handle once again. Where are we on sterling with that scenario?
That scenario, we're probably moving sideways on sterling, but it's going to be volatile around the politics. You might see a bit of a relief rally if, say, Rishi Sunak, he's the market favorite, wins and becomes prime minister. But the world is really suffering from a strong dollar, and understandably so. We have a major war in Europe. West is in recession. You want deep liquid US markets, so you hold dollar assets. It's hard to see until the market turns more risk on, that dollar strength starts to come out. And so we're all going to be weak against the dollar for a while. That probably is a story for next year before we start to see this position reverse.
On a Friday, Callum Pickering, thank you so much with Berenberg.
Pleasure. Thank you.
Here for reading over the weekend. I look at this, Lisa, and as I mentioned earlier, started with John Byrne Murdoch in the FT on really questioning, as is Tim Colpin at Bloomberg, how you measure GDP in China. And he cites a University of Chicago paper that it could be half as much growth as we're actually seeing. So I've got a scenario out to think about over the weekend of they finally wake up to the anti-science of COVID and pushing against that. is all the challenges of a Pacific Rim slowdown. Which way do you go? I have no idea.
And that feeds into the idea that we were just hearing there from Callum Pickering, which is that dollar strength will persist. And this is the opposite of what we heard from Sebastian Gailey and Mark Chandler, because the rest of the world is flat on its back. And who does that hurt more? The Chinese slowdown? That hurts more Europe. That hurts more Germany. So then where does that strength come from that forces the dollar into a weaker position anytime soon that eases some of the inflationary imports of the European region and beyond?
Well, it's very emotional here. For those of you on radio, there has been imagery over the last number of hours and indeed days as well. And I think Lizzie Burden, of course, reporting from 10 Downing Street yesterday, captured this image. For those of you on radio, it's Lawrence the Cat at the podium outside 10 Downing Street, getting it done. And some humor here. You mentioned this yesterday, Lisa. The gallows humor is tangible. And of course, we missed the walk of the cat back to the door, but
someone also pointed out they put an Airbnb sign above 10 Downing Street. That was another meme that was going around. There have been a lot of them where they try to, understand exactly how quickly this story
We will try to keep the reporting more than distant from Lawrence the Cat. We can do that at Bloomberg.com UK. A terrific summary of all going on in London. This is Bloomberg.
Should we anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future?
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
Welcome to Bloomberg Crypto.
covers the world like Bloomberg.
Because Trustonomics is being dismantled, MPs behind the scenes are asking, what's the point of having her at the top?
Can the strong dollar amplify the world's risks of instability?
Xi Jinping said complete reunification must be realized.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
We're going to find that this is going to be an even tougher environment than people think.
The liquidity in the market remains good.
Markets are starting to price in the idea that whatever U-turn is going to happen, nobody is guaranteed that there will be a new turn around the corner a week from now.
The reality is that hard activity data are still pretty strong.
What we're saying about 2023 is we think the first half is going to be really sloppy. That's when we think numbers come down. That's when we think we're going to be dealing with a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
When does something break? Welcome back. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. John is off running for Prime Minister in London. Right now, we are here with a market that is moving so quickly, Tom, that it really is hard to keep track of. Yields higher, dollars stronger, the rest of the world flat on its back.
And you've said the smartest quote into the weekend reading, which is this fear of the break, because what hasn't happened is we haven't broken. Now, these reaction functions, we're going to talk about this with Alicia Levine, but I'm sorry, Lisa, there's enough movable parts on a Friday where you have to lean in to try to get to the Asia Monday morning. Yen 152 rounded up is all you need to know.
I'm glad that you pointed to the yen. When does something break really paints a picture for Japan right now.
Never see it
Earlier
coming.
this morning, people were saying, when do they come in? When do they intervene? They've intervened before. They're not intervening. 150 was the level. We're 151. We're above that, and it's still not really coming.
I turned away to talk to Alicia Levine about the scam known as the SAT exams, and 10-year real yield moved to a 1.80 just while I looked away.
But that's my point. This is moving quickly, even after all of the increase that we have seen in yield, even after all the reset, even after markets price in a 5% Fed funds rate for the first half of next year. How much more can we possibly do?
I think it's a movable, we got the British distraction here right now, but away from that, and you and I have been remiss on this, the data on the Bloomberg screen has really been the story of the week. Can I just mention that the Bloomberg Financial Conditions Index has gone against Chairman Powell and has moved from significantly restrictive up to a gross accommodation, and again, 1.80 10-year real yield. That changes the discussion for global Wall Street.
Well, and this goes to the point that we've been hearing about from Mike Wilson over at Morgan Stanley. He said that expect a bear market rally because expectations are so low, earnings will come in and they'll be better than expected because that's what they do. They guide people lower and then they beat those very low bars, and that's what we have seen with some companies. It hasn't been enough, and that to me is a pretty big takeaway. With American Express, one of the bellwether types of companies, coming in short as well as the shipping sectors.
Yeah, I'm going to mention it. I'm much more interested in Verizon, which has been a challenge for over 10 years, and they're talking about cost cutting of some form. I guess we're going to see a lot more of that into the end of the year.
We are seeing weakness, and we're seeing the weakness deepen as we see yields continue to climb.
There's the Bramble gloom.
Well, come on. Let's take a look at what's going on. We're down 0.6% on the S&P, and it has been heading lower throughout the morning. At one point, it was really trying to stay flat. You are seeing the euro continue to weaken. This is a dollar strength story, and that, to me, I think is pretty pervasive across the world with the pound, with the euro, with the yen, 97.47, and 10-year yields. I mean, honestly, to see just on the cusp of 4.3%. Could we see 4.5% by the next couple of weeks?
I'm looking at the real yield and not the nominal story, and it's just completely changed story. How do you write your year-end essay right now? I have no idea.
What do we do? What do we do? What do we do? Go to cash. Go to cash. Triple leverage all cash.
I think that's the title of Alicia Levine's.
Well, Alicia Levine actually joins us here without the Star Destroyer behind her. Alicia Levine, head of equities and capital market advisory at BNY Mellon Wealth Management. What is your view, Alicia, and how you view this move upwards in yield? Are we watching something break in slow motion?
So I don't think we're watching anything break, but we shouldn't be surprised at this because that last CPI print
print really said it all. Core inflation is now higher today than it was in 1982. Forget the top line, it's the core. And that's ultimately what central banks are looking at and what the Fed is looking at. And that's our problem. What's amazing to me is that ratchet up in yields this week, the equity market kind of shrugged it off. You would have thought there would have been a more dramatic reaction there. So I think we get something in the next few days to reflect what's happened with yields and with rates ratcheting up higher.
You are hugely adept at the mathematics of the moment. I want you to correlate the bond dynamics we're all talking about over to how you reset for equities into next year. Can you link the two beasts together, or are they non-correlated?
So I think you have to link the two together, because in this year, equities were really the caboose and the bond market was driving the train here, which I get teased about, blaming the bond market. But it is true, because your multiples get compressed when yields and rates move higher. What the market is doing is pricing in an over 5% Fed funds rate. You're going to feel it on the equity side. You can't avoid that. It's all one system.
Okay.
You don't have assets that just trade on their own. It's against the risk-free rate.
But in a log Euclidean space, or even if you go to some fancy XYZ space as well, is it non-linear from here in the dynamics of the bond market pushing stocks around?
So that's a really interesting question. You're asking, has the work been done? Right? You're asking, have we had enough multiple compression? And I think the answer is the direction is still in a volatile way, but I do think a lot of the multiple compression has already been taken care of, because if you think we're headed into recession the first half of the year, you're going to wind up with lower yields eventually. And that, in a weird way, is going to support the market. Also, the earnings season is coming in, Lisa, as you pointed out, better than expected, in part because of inflation, in part because we had the financials report, and so they're doing well on net interest margin. And, the high-end consumer is spending. Think about Nordstrom's. Think about LVMH, and travel. So people are out there spending. It's not a total collapse yet. So you could have some stabilization as you have two-year yields move higher.
So what happens first? The Fed blinking, or seeing yields kind of get out of control and cause some sort of torpedo effect in the multiple valuations?
So I don't think the Fed blinks. Okay, so the Fed will blink if there's an event. And right now, the UK walked back from their event, which walked back the event on the global bond market. And they seem very intent on getting higher here. And they've really trapped themselves, right? They've trapped themselves because they keep on talking about CPI, which, as you know, is backward looking, because they want to signal to the average household that the Fed is on the inflation job. It's backward looking. We still haven't seen the effects of the rate hiking cycle for another 6 months. So, you have signs, housing's rolling over, you have signs of a slowdown, but the Fed's out there hiking with old data.
Meanwhile, taking a look at what we're expecting from earnings, we get some of the big tech names next week. We have seen Snap. That was concerning, and it's been very concerning this morning for owners of Meta, which already has tanked. Facebook has lost a significant portion of its value. How much more do the tech bubbles have to burst at a time where they've already been devalued dramatically?
So high growth names, when they stop growing high growthly, get not only an earnings downgrade, but you get the multiple compression as well. So to the extent that you have stocks that are still trading at 40 times next year's, the tech names are still too high. Ultimately, those names have not been driven down dramatically.
I got to slip this in. If there's a factor adjustment into 2023, and I'm really big on the zombies that are going to be taken out in this new rate regime, what do the non-zombies do, and which factors matter next year for the profitable non-zombies?
So there will be a wave of M&A coming from the non-zombies, and cheap, right? You're going to have really fire sale of companies here for IP as well. You could have M&A just for IP in some of these sectors. But, ultimately, to the extent that companies raised cash during the time of near zero rates, you should have some resiliency there. I think the credit cycle happens in the private markets, in those middle markets where they couldn't quite raise the cash, because the corporate America is flush with cash right now. The refinancing there is not going to be the problem. And ultimately, the American consumer, you know, looking at the unemployment data yesterday, the new claims data, I mean, we're at rock bottom.
Yeah,
there is not a problem in the labor market here. So, you know, you have this weird push-pull where you're getting the bullwhip effect on inventories, and you've got labor working and spending.
Yeah. Alicia Levine, Too Short, thank you so much for being with us. Alicia Levine of BNY Mellon Wealth Management. That is one of the most fascinating points, Tom, this idea of the private markets being where the big reset comes. And we heard from Harvard's endowment, and they actually said that they outperformed what they actually expect to have done in retrospect because they haven't yet seen the big markdowns in the private markets from some of their managers.
I like what we heard earlier this week, where we go back to alpha, where individual security selection, bond stock, really begins to matter. I can't emphasize enough the percentage of people out there that have never lived a Sharpe ratio, a legitimate risk-free rate into the risk-reward calculation.
Who've lived by indexes, who've lived by blanket buying.
They've lived by the great disinflation. Right. It's gone.
And so now what happens when you get a credit cycle in assets that you actually have to look at, right? I mean, that's what we were just hearing from Alicia. And I thought this story was interesting. Apollo and JP Morgan are working on building out secondary trading of private credit because they're anticipating the same kind of thing. And there's been some reporting on that because they expect that to be.
They're going to trade Bitcoin?
Well, I mean, I guess.
What I would say is in the 8 o'clock hour on a Friday, we have Alicia Levine over to Steve Major of HSBC, and that's what the show's all about.
Absolutely. Steve Major has been really out front. He's going to have a pretty controversial call. I don't think he sees up and away for yields the same way that perhaps Larry Summers does.
No, it's going to be fascinating. Plus, he's got to talk about Aston Villa and Steve Gerrard out the door.
Well, I will let you spearhead that.
I'll have a monologue on that because where the hell is Pharaoh, right?
You're going to have a monologue on that coming up, hopefully without just too many monologues. Stephen Major, Global Head of Fixed Income Research at HSBC. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Kriti Gupta. Biden administration officials are said to be discussing whether the U.S. should subject some of Elon Musk's ventures to national security reviews. Sources say that would include the Twitter deal and SpaceX's Starlink network. U.S. officials are uncomfortable with what they see as Musk's increasingly Russia-friendly stance and his plans to buy Twitter with foreign investors. Ukraine's foreign minister says he talked with Israel's prime minister about Kiev's request for defense systems to help combat Russian missiles and Iranian-made drones. Israel has offered to assist Ukraine with a missile warning system, but says it will not provide weapons. The U.S. has accused Tehran of sending trainers and technicians to Crimea to support Russian drone attacks. American Express has slumped after it set aside more for bad loans than analysts expected. It suggests rising interest rates could start hammering customers' abilities to pay their bills. Provisions for souring loans were $778 million in the quarter, worse than the $573 million analysts in a Bloomberg survey were expecting. The European Union has agreed to press ahead with a set of emergency actions to address the bloc's energy crisis. It comes after Germany yielded to pressure from other member states to pave the way for a temporary price cap on natural gas. The European Council's president says the move sends a clear signal to the market that the bloc is ready to act together. And Credit Suisse will aim to settle a tax fraud and money laundering case in France on Monday. The Swiss lender is reportedly in the final stretch of negotiations with prosecutors to reach an agreement that would include a fine but no admission of guilt. The size of the settlement is unknown, and the deal could still fall apart ahead of the court hearing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kriti Gupta. This is Bloomberg.
to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg. Earnings season is here.
It's bracing for another big earnings season.
Everyone is expecting it to be poor.
We've had big markdowns on earnings.
Bloomberg breaks the numbers first.
The bar has already been set pretty low.
The big question is, can it go lower? We're seeing some pretty bad earnings already from those who have reported.
With exclusive expert analysis.
Which aspects of the market are not sufficiently priced?
Is this a macro huge headwind?
There is some really bright light at the end of this tunnel.
When is this floor going to come? When can I start buying?
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
I think that as we move forward, we're going to find that this is going to be an even tougher environment than people think. And I've been advocating something I've been advocating for a long time. This might be the return, to use the Wall Street term, alpha. This might be the return of stock pickers and bond pickers.
Tough. That was Jim Bianco, president of Bianco Research. Tough today in the FX market. Bonds on the move, currencies on the move, and it is a strong dollar. It is weaker bonds across the world. Yields up. Tom, things, it feels like, are starting to break around the edges.
Right.
With right now the Japanese yen at 151.8.
We're going to dive into this with Steve Major in the next half hour, but to take 30 seconds and steal it from Ed Ludlow on Twitter right now, we are at a moment here. I can't say enough, folks, looking at the Bloomberg terminal, the critical breakage points here on the Bloomberg Dollar Index, which shows, I'm going to talk pro talk here because it's that important. Short-term convexity on Bloomberg Dollar Index taken log. I see the yen breaking out with new velocity towards a 152, and sterling, with all the politics going on, Lisa, is absolutely textbook short cable, textbook chart. short cable right now.
But how much is this really being driven by the dollar story and the yield story? And I say this because, yes, the UK has been a train wreck in terms of the political turmoil. However, you're not necessarily seeing this just only isolated to Great Britain. It's also the yen. It's also
It is
Europe.
absolutely global. And I got to stagger back to one statistic here before we get to Twitter. 1.81% on the U.S. 10-year real yield. That is moving. That is almost to the phrase leaping logarithmically up. And from a 161 to a 180, maybe that's the one statistic that helps.
We're talking about how quickly yields are moving on the flip side of the dollar and the real yields, the nominal yields, 4.33% for the 10-year Treasury yield. At what point do we end up with something that really is a game changer in terms of longer-term expectations?
Keep you abreast of this, and of course, looking into foreign exchange is the deepest part of the market. The deepest part of Elon Musk's market is, well, maybe it's not going to work. A number of items out this morning saying he may have another cash call to finally get this transaction done. Edward Ludlow joins us right now, expert on all this. I think there's 4 Musk stories this morning. Which one matters for his ability to get this transaction done?
Yeah, the Bloomberg report that DC is antagonized by him.
This is about Biden, National Security
Council. Yeah, so Bloomberg
Council,
reported that according to sources, his recent behavior and commentary around the war in Ukraine, about his brief threat to remove the Starlink connectivity services that he was providing to help the efforts in Ukraine, and also just simply the deal to buy Twitter. Our sources tell us that across a range of government agencies, they're thinking we might take a look at this. Now, by the way, public service announcement, the White House has this morning said that it's not aware of any review of Elon Musk's security clearance or any security review of his businesses. But clearly they're thinking about it. This isn't the first time it's happened. 2019, he goes on the Rogan podcast, smokes marijuana. He also leads the biggest private space company.
Come on. You're not going to equate marijuana with a guy who builds technology which helps Ukraine in battle.
I'm not. All I'm saying is that this discussion around Elon Musk's behavior and his security clearances, remember, SpaceX provides services not just to NASA, but to the military and the Pentagon, but also he's a big contractor, right? And they simply said this is not behavior forthcoming or fitting for somebody who has this level of security clearance. The bigger issue around the deal is this. Ironically, we'd reported things going pretty well. Bankers on both sides working. The bank's getting ready for the debt call to come in, right? And then this comes out and it throws the deal into doubt, and you see that reflected in the market.
This is a distraction, let's be honest, because Twitter has been an ongoing distraction, a story unto itself with the Elon Musk kind of hubbub, but it masks the real story even at Twitter, which is that they were planning cuts at the company even before he got involved, that this was a company that was really struggling. And you're seeing that not just with Twitter, but the social media facing tech companies more broadly, as we saw from Snap. I mean, how much have we seen the reset already take its course versus have more to go?
Going back to what Jim Bianco just said on this program, the shock is greater than we expected. Actually, we thought the softness in the advertising market was done with. After the war in Ukraine and in Europe in particular, we had the commentary from Alphabet, parent of Google. We had the commentary from Snap actually already. But the wording in their earnings statement was so specific, a pullback in spending by advertisers. They're decreasing budgets, and all of these names are fighting for a small pool. Why is it important? It's actually a pretty good lens into the macro picture. Advertisers pull back their spending because consumers aren't spending. Why? They're hurt by inflation.
People are probably not interested as much in tech right now because they're looking at markets and they see, hold on a second, and they see yields moving dramatically. But this is part and parcel of potentially a similar story. The free money is over and tech is going to be reeling, and that is what we're seeing right now play out.
My eyes didn't light up just because I'm interested in tech and I'm trying to justify my existence. But, I take Citi, for example. They have this call where they're overweight global tech. Why? Look at the specific names, the one with the strong balance sheets, with the entrenched market positions. When you're trying to work out what to do in an earnings season and where earnings on an EPS basis will hold up better than other corners of the market, there is a thinking that actually, of course, Apple's going to fare better here. They're more nimble. They've got the cash to flex. They're smart about how they handle the economy globally. So there is some optimism out there around global tech being a better play, almost like a defensive stock.
Yeah.
Do you buy that theory? I don't know. But there is some corner of the market that believes that.
We'll perhaps find out. Ed Ludlow, thank you so much, of Bloomberg. We'll find out perhaps on Thursday with the earnings. Right now, stocks and bonds very much on the move, yields higher, and the dollar really preeminent, Tom, around the globe.
Well, when Bruce Galbraith tweets in and says, Tom, give me a DXY quote. I don't have my Bloomberg with me. Bruce, good morning to you. DXY 113.86 out to 114. 115 is an unimaginable print. And I'm going to go right back to the IMF meeting where on camera and off camera, it was the same thing. They're watching swap lines, which is the borrowing of overnight money, think Friday, between major countries, including Switzerland. It's confusing, it's advanced, and critically, the nations that do not have available the ability to go out and borrow gajillions of dollars overnight, that don't have swap lines. And I'm going to say that these are the shadows cast right now by the rumors, the speculation, Lisa, about the unknown of swap line discussions of the IMF and all the major central banks.
Are you suggesting that there's some sort of backroom negotiation that has to be going on?
No, I'm not saying back room. I'm saying I'm looking at the Bloomberg screen on a Friday, and it's giving me all sorts of information that there's something going on out there. I don't know what it is.
I think that there is something going on. There is yields higher, and there is the dollar markedly stronger, and even more so as the moment goes on. And I do have to keep coming back to the yen. We had expected intervention. It has not come yet, at least to the satisfaction of markets, with a pervasive weakening in the currency as they stick by their yield curve.
Their goal is control there, and the way you get control is Saturday, Sunday into their morning. Stay with Asia and Bloomberg Radio and TV here on Sunday.
And Stephen Major, he's coming up. Cannot wait for that discussion.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Stronger that moment that you're lifting the barbell, you get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
When U.S. inflation numbers are released,
The score is inflation one, Fed nothing today.
Bloomberg brings you crucial data at terminal speed.
Core CPI in America, 40-year high.
Yields are absolutely flying.
Equities down and down hard.
It's ugly.
And instant expert analysis.
What is the makeup of this inflation?
We are watching the underlying fundamentals.
Will they go 100 basis points?
The downshift just keeps getting pushed out. Now it looks like we're going into extra innings.
Nobody covers the economy like Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Surveillance on Bloomberg Television and Bloomberg Radio. Tom Keene and Lisa Abramowitz. John Farrow is not really running for prime minister. He is off. We are seeing markets on the move. Stocks lower at session lows, down 0.7% on the S&P, down 0.8% now on the S&P. Euro at 97.14, weaker versus the dollar. Yields really are, to me, the driving force. Yes, it is a dollar story, but it is also very much a yield story with 10-year yields at 4.32%. Real yields crossing that 1.8% level. Tom, to me, this is a market that is facing some sort of reckoning. Have people gotten over their skis with how high yields can go?
What surveillance is about is you get lucky. And we got lucky yesterday with terrific work, particularly with David Merritt, who led all of our Brexit coverage ages ago. And Lisa, I thought it was just great yesterday to have everybody, Micklethwaite and the rest of them, weigh in on the absolute chaos there. You think we got lucky this morning?
Without a doubt, with bond vigilantes in the front seat, huh?
Dragging himself back from Hong Kong, Stephen Major joins us now with HSBC, Global Head of Fixed Income Research, and we're thrilled he could join Bloomberg in our New York studios. Forget about all the market talk here. What is the experience of living in Hong Kong under quarantine?
It's getting easier, Tom, much easier, and I can't wait to go back because we're free now. There is no quarantine. So I've done my time now.
You think they can salvage their relationship? I don't want to get you in trouble with HSB management, but you are optimistic they can salvage their relationship with Western banks to stay a financial capital?
Yeah, I think all the moves are in place, and November is a big month. Many people are going there, so yes. Yeah.
We are thrilled you join us for this entire half hour. You are known as someone that has said price up and yield will stay down. We've seen a major adjustment here. What is the new major look on how yield finally crawls lower and price higher? When do we get there? How do we get there?
Don't you have a show called Real Yield?
We do.
Is that one of John's ones?
Yeah, I'm moonlighting this afternoon.
You're doing it. Well, at least it's relevant now because you actually do have a real yield.
No, it's relevant because Lisa's doing it and John's not doing it.
Actually,
but continue.
Yeah, let's have fun at John's expense.
24/7. Continue, Mr. Major.
But if you can get real yield anywhere near 2%, that covers real GDP. So if you're building a portfolio from scratch, and you know this is without being encumbered by all of the carnage in markets the last few months. If you're building from scratch, 2% real yield covers GDP in the longer run. So we don't know where inflation is. It seems to be a good place to start building a portfolio with a real yield close to 2.
So let's just put this into something that's very clear. Do you see 10-year yields at 4.3% in the U.S. as a screaming buy, load up, because we are not going to see yields like this again?
Yeah, well, fortunately, I work with some professionals who contain my enthusiasm, because I would have been buying every week, right? So that's why I'm not a trader. But the point is the valuations today show a very strong recency bias. I mean, I can honestly believe that yields will keep going up in the near term, but you could also build a plausible scenario that there's a hard landing and that yields should be less than 2%. You could build that scenario. The question is, what weighting do you put on it, right? So at the moment, we're pricing a very high probability of the Fed going to 5 and staying there forever, which doesn't seem plausible.
Well, a lot of people, and this is something that I was really excited that you were coming on to push against. What I'm hearing increasingly is that there is a stickier, more pervasive inflation over the long term, and that the Fed funds rate is not going to go below 2% anytime in the next decade, simply because of the deglobalization or the localized globalization, some of the population trends, and some of these other macro factors.
Yeah, I don't think the longer term picture has changed, Lisa. Demographics, debt, wealth inequality. That the explanations for low R-star have not reversed. I think you can give me some arguments that maybe underwrite or underpin the R-star, but not reverse it. I don't think you can reverse the pre-pandemic trend.
Just to quickly follow on to this, then do you think we're going to see 0% rates in the next 5 years?
I think you'll get a hard landing, and the probability of the market pricing a return to the zero bound cannot be ignored. So it's all about probabilities. The markets are pricing rates at 5, right? So the 2-year yield can be 100 to 150 over the current money rate. In an easing cycle, the 2-year can be 150 through the money rate. So that's not happening this week, but sometime next year, the market would not be wrong to be pricing in an easing cycle.
I got a zillion angles here. If you're on radio, Stephen Major with us with HSBC for this entire half hour. And the one angle I want to talk about is you mentioned the breakage that could be there, and what we're observing right now in the markets, DXY getting up near a 114 is without question the focus at the IMF was on swap lines.
Yeah.
Is it enough of a power in the foreign exchange market to see dollar strong, where there's a swap line demand or a desire for swap lines, even if I can't get them? And is that enough to make Jerome Powell blink?
There are a number of economies in Asia where there's been a tightness in the funding markets recently. And looking ahead to year-end kind of pressures, we had a fire drill with the UK, which showed what lessons did we get from the UK? Fast moves are dangerous. It isn't just the level; it's the speed, right? So I wouldn't be surprised if the Fed was watching that very closely. Was there a point a week or so ago when people were worried? You see, at the moment, what happened in the UK wasn't enough to distract the Fed from its hawkishness. But who's to know if something spills into a market somewhere? And in fact, it'd be wrong of me to speculate, but there are so many pools of leverage in the global economy, so many areas that need to refinance. And when the dollar is moving like this and the rates are so high, the spreads are so wide, there's going to be some pain. So I don't want to come on here and speculate as to where it is, but you're right. The swap lines are being looked at because there's tension.
Do we have good data now? John Byrne Murdoch, first thing I tweeted out today over at the FT with a fabulous essay on the opacity of Chinese economic data. Do you feel sitting at your desk in Hong Kong that you have good Pacific Rim data, that you have good global data, or are the tensions germane as you see in the swap line debate?
I think we're always struggling to catch up, Tom, and we're all experts about LDI now in the UK, but we weren't before, were we? Like, we can all quote numbers and talk about what happened. But
Can I do a shout out to Jordan Rochester? Nomura just killed it. I found a Nomura paper from 4 or 5 years ago on LDI that absolutely nailed what was going to occur.
So we're all experts in LDI, and we're also all experts in British politics. I'm wondering, as you talk about the speed, and this is something people have been talking about, what happens to 10-year Treasury yields if Japan abandons, perhaps, its peg, or has some sort of failed intervention, as we see almost 152, 151.9 right now on the dollar versus the yen?
We're trying to game this one out. With US yields here, if the YCC was changed, if there was an iterative shift, it would have much less impact than where yields were 1 year ago. So if Japan had changed its policy, global fixed income could have been de-anchored a year ago. If they were to do it today, it kind of doesn't matter so much because they're going to be adjusting into a bigger spread because US yields are so high compared to Japan. So the Bank of Japan estimates that the 10-year JGB would be around 75, 80 basis points if there was no YCC. But we're not. This isn't black and white. It's not going to be no YCC. It's going to be an iterative shift. Yeah.
What you're saying, though, is important, which is we've already done a lot of the work to reduce the shock value of how quickly the moves can be. Does this mean, perversely, that you end up with yields higher for longer because there isn't some sort of trigger that causes some sort of monetary policy to step in?
Higher for longer? Well, that's a good one. So is that the opposite of lower for longer?
Yeah, exactly. Well, we saw that for a long time.
No, I think that when you've had a once-in-a-century pandemic and all the other supply-side shocks that we've had, we shouldn't expect a return in the space of a year to what we had before.
Right.
It's a multi-year process. I think that 3 to 5 years out, we'll be back where we were in 2019.
You're going to be with us for the whole half hour, which is really, really great. We're thrilled by that. John from Glasgow emails in and says, soccer talk time with Steve Major. Noel Quinn comes in today. Noel, thank you for watching HSBC. He says he's paid for you to see 4 Premier League games in the last 10 days or something. What'd you observe here? And give us an update on West Ham and the rest of English football.
I was very lucky when I was back in the UK. I saw 5 games in 8 days. At West Ham, which is my club, and I also went to Arsenal. And it's just fantastic. The quality of football is just getting better and better every year. It is amazing. It's such a privilege now to go to games.
That's what John Farrow says exactly. Can star players be good, what we would call coaches or managers? Gerrard out at Aston Villa.
Yeah.
Is it just too hard for a player to do that?
Well, as we know, Steven Gerrard was a superb player, but I think the step into management is difficult because, I mean, how do you motivate and manage these multi-millionaire players just because you happen to be a player yourself? I mean, management, as we know, is a particular skill. The guy that runs Ford doesn't have to be an engineer. For example, right? Yeah. And so you see someone like Mourinho. He wasn't really a player, but he's one of the best managers of all time. So, yeah, I think Steven Gerrard's an interesting case study.
Was that enough soccer talk there, Lisa?
Sorry, I'm looking
I'm
looking at yields. No, I'm looking at yields, which have been really on the move.
We did that for John. We missed John. You know.
Well,
it's so obvious that Lisa's not interested.
You have no idea. You have no idea. With that, we're going to save the half hour and come back here with Steve Major. Lisa, take us out, but I'm sorry. I've got velocity on dollar strength here that's extraordinary.
113, almost to 114, really. And I will just say, I think it's awesome. It's just a foreign language to me. You have to be following it, and then, if you're not, then it's hard to know. But I am following the bond market.
Lisa,
yes.
It's a foreign language to me. I just fake it.
Do you want me to try to fake it? I think people would cry. I think that they'd put a cat up at this seat instead of me in front of 10 Downing Street. Right now, we are watching the S&P lower by 0.8%. And you can see that yen really close to 152, 151.93. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Kriti Gupta. The White House says they are unaware of any national security review for some of Elon Musk's ventures. It's been reported that U.S. government and intelligence officials were weighing in on the possibility of using tools to review Musk's multiple ventures. Those ventures were said to include the Twitter deal and SpaceX's Starlink network. President Biden has started aggressively promoting his student debt relief plan. The government has been working out kinks in the program. A White House event Monday is set to officially launch an application website. Meanwhile, multiple legal challenges, including a lawsuit from Republican-led states, are moving through courts, threatening to halt the effort. China has locked down parts of a central city, confining some of its 13 million people to their homes for at least a week. Other major hubs are rolling out virus restrictions as well, reflecting the country's commitment to its COVID-0 policy. Residents in high-risk areas are required to stay at home until no new infections are reported for 7 days, and they get moved to medium risk. Italy's Giorgia Meloni has clinched a mandate from her coalition on the path to becoming Italy's first female premier. The coalition, which includes her Brothers of Italy party, former Premier Silvio Berlusconi's party, and Matteo Salvini's League, told President Sergio Mattarella that she is their candidate. Mattarella is expected to formally ask her as early as Friday to try to form a government. Kering posted slower sales growth than luxury rivals LVMH and Hermes during the third quarter. The company's Gucci brand was said to be held back by China's continuing COVID-19 restrictions. Kering CFO told analysts the Italian brand's revenue from the mainland declined during the quarter, and the situation there is still not back to normal. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kriti Gupta. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
I would not be surprised how fragile financial markets are, that the Fed has to pause to get them back under control. The U.S. financial markets are in a good place right now, but if nothing else, the UK has shown us how fragile to an event, to a bad policy decision. So I don't feel confident about what they're going to do in December, let alone where we're going to be by June of next year.
She is a former Fed economist that barely describes the academic contributions of Claudia Sahm. She's controversial with us today on the Fed, and she, not only that, she has her own ratio, if you will, the Sahm measurement of recession, which you can see throughout all the Fed system. She's had really quite a splash academically, and then linking it over to all the punditry that we see each and every day. We welcome you to Bloomberg Surveillance on radio and television. And what a joy, some quiet moments here with Stephen Major of HSBC in a very unquiet time. My study, and this goes back to Martin Feldstein of Harvard, is that these things end stochastically. Things move, and they don't level, they don't plateau, they get pointy, they turn around in reverse. What is the stochastic event that will allow some of the carnage I see on my screen to reverse?
That's right, Tom. I think that it might even be a bimodal market. So you've got one mode that's got this strong recency bias, and then there's the other one that prices in an event. I mean, the facts are that the median number of months between the last hike and the first cut, based on the last 70 years of data, guess what? 4 months. The mean is 8, so it's skewed because of the 2006, 2008 period. But my point is, you just look at the numbers. Once they've hit the peak, the market is not wrong to be looking over the other side. And what's the event? Well, the UK could have been, if the UK event of fast-moving yields and disruption somehow affected the US financial markets. I'm talking here about money markets or mortgage markets, or you said swap lines, all this stuff. Who knows? That makes the Fed think twice about going all the way to 5 or above.
You're living in Hong Kong, you're living the anti-science of China. Fine. The anti-science of monetary policy is Japan. Everyone knows this. What are the ramifications to the Steve Major world when they capitulate on YCC in some face-saving form and you get yen 152 to 129 over literally a cup of coffee?
Yeah.
What happens to the system?
I don't think you get the shock that you could have had if they'd changed YCC a year ago. Because of where US yields sit today, they're so far above. So they can soak up easily a Japanese move. I imagine that the Japanese curve would flatten. So it would be a bear flattening because the curve is so steep between 10 and 30 years. Now, in global fixed income, that's not gone unnoticed. If you're sitting in Germany, you can switch from your local market into JGBs and pick up yield because of the curve steepness and the hedging. Because Japanese rates are below 0 at the front end, whereas ECB and Fed are hiking. So there are opportunities here in global fixed income from the divergences.
To go to your arch thesis, as they manufacture what I'm going to editorialize here and say a pseudo-inflation, are we essentially going to have a stochastic move back to disinflationary trends in the arch major theory, which is some forms of deflation?
I think so. And from a Japanese perspective, if you've waited 30 years to come out of deflation, a couple of months of +2, +3 doesn't do it. And that's the Kuroda approach. We don't know who Kuroda's replacement is going to be. He or she won't be in place until next year. So it's just speculation on our part. And I feel very much that's all we're doing. Right? We're trying to game it out anyway.
And now, folks, we dive into our World Cup coverage. We do this without John Farrow, which is unfortunate. You, of course, have a global mandate. You're going to be in the Middle East. I guess you're going to attend the World Cup. Can you explain to mere mortals like me how we see a good product with 80?
It could be completely different. I mean, I'm going to go and see some England games. I'm lucky enough to get tickets, but I think it's going to be a strange World Cup. It's going to be surreal because in that kind of heat, it will be a lot cooler than it is in the summer, obviously, but the game's going to be slower and I guess more measured. It's not going to be as crazy as the Premiership because you've seen how fast they play in the Premiership. You've seen it yourself. Yeah.
On sterling and gilts, let's finish there. I've got a 110.84. We've moved a full stick here on sterling this morning, 112 down to 110.87. It's inappropriate for you to comment on the politics, but please, on the pressures that Governor Bailey faces.
Well, he's reiterated the independence, and I think he's been pushed into a bit of a corner. I mean, it didn't help that the Bank of England was hiking at a pace less than the Fed before the events in Downing Street. But the Bank of England's role is quite interesting here because they are buyer of last resort and they've shown their ability to do that. And I think the gilt market has actually calmed down quite a lot. And one of the big differences between the UK and US is that things can happen very, very quickly in the UK. All of those fiscal proposals have basically been abandoned.
Could you be long 10, 30-year gilt this morning?
I think
price up, yield down.
I think you can start to look at it, and I'm interested in how gilts look compared to equities, for example, and there will be a lot of fund managers looking at those relationships, bonds versus equities. It's the same in the US. There's a point when you have to start favoring bonds over the risky assets, and I think that's. Ultimately for the Bank of England, it's they've got the QT, they've got the QE, they've got the policy rates, they've got to work with the DMO on patterns of issuance, which could be modified. I I think that the worst is past us now, and I think we'll probably see a period of calm after the shock.
The period of calm will come after your view forward for 2023. A theme for 2023 that we may see written by HSBC.
Yeah, I'm not going to front run the research because we haven't published it.
It wasn't, I mean, did you hear that, folks? I didn't hear that. I don't know.
We haven't even sat down. I think we'll be pleased to get to the end of this year.
Try to get to the end of the month. Stephen Major, thank you so much. Greatly appreciated this morning. He is with HSBC, and this is what we try to do to bring you the conversation on this in settled times and decidedly unsettled times as well. I have a minute here to summarize what we've seen this week. It is absolutely extraordinary, and please stay with us through the weekend as we stagger to the Asia morning, 7 p.m. Sunday here in New York. Let me go to the deepest market, foreign exchange. You can see that with DXY dashing up near 114, a 115 print on that major trading index series would be extraordinary. Euro doesn't give me any information today. Sterling simply weaker against all that we see to Monday morning. Thank you, Tom McKenzie, outside Parliament with 110.93. Even dollar Canada looking 138, 139 is extraordinary. Oil not part of the story today. And equity futures, a little bit of a weight to the tape here as we stagger 30 minutes to the open. Please stay with us through the morning. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. No one covers the world like Bloomberg.
Because Trustonomics is being dismantled, MPs behind the scenes are asking, what's the point of having her at the top?
Can the strong dollar amplify the world's risks of instability?
Xi Jinping said complete reunification must be realized.
with unmatched reach and resources from more than 120 countries. The moment news breaks, 24 hours a day. Bloomberg, your global business authority.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. When does something break? We're not seeing it in the equity markets. They are down, but it is not violent. However, in the bond market, yields climbing to decade highs. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
We begin with the big issue. Treasury yields just keep on surging.
These yields are not all overdone, at least not yet.
The story of this year has clearly been higher bond yields.
The rising bond yields.
We're back to a different era, and I think that we will stay here.
It really comes down to inflation.
We keep going back to inflation data.
We're probably going to see persistent inflation,
and that keeps yields still a bit on the upside.
U.S. data is not going to provide much leeway for yields to fall.
The underpinnings of the economy here in the U.S. is really quite robust.
The reality is that hard activity data are still pretty strong.
What that means to me ultimately is that the Fed has to do more to slow down the demand side.
The two-year yield always peaks above whatever the terminal rate is.
We still got about 75 basis points more to discount.
For a bond investor, it's all going to be about rates.
It is all about yields right now, 4.3% on a 10-year yield in the United States. As we were talking, Gregory Staples of DWS and Stephanie Roth of JP Morgan, we've been talking about could they get up to 3.5% a couple of months ago, even a month ago, and yet here we are. Gregory, what do you make of the move that we're seeing today?
You know what, I think what's been going on is that the markets really had a sea change in their perception of what the Fed's going to do. If you go back to the summertime, there was real skepticism and a sense that a pivot was going to come fairly soon. And the Fed speakers pushed back against that fairly hard, and now the markets embrace the tightening with an almost evangelical passion. The market's almost ahead of the Fed now, pricing in 5% by the first quarter of next year, and you're seeing that reflected across the curve, and now for the first time it's really starting to impact the long end. Are we close to the end? I don't know, but boy, oh boy, we've come a long way in a very short period of time.
Stephanie, what's your view here, especially as we see the pace of the move this morning? We've retraced from some of the highs, but still at the highest levels in the 10-year Treasury going back to 2007.
Totally agree with Greg in that it was driven initially by the economy holding up better than expected, inflation remaining higher. But more recently, the move seems to be less fundamentally driven. It appears to be more about illiquidity. And that could mean that the 10-year could back up even higher than where we are today. But we do think eventually rates should rally. And we do think that on the back of recession fears and recession actually playing out in the middle of 2023, rates should rally. It's just a question of how high does the 10-year get before that happens.
Well, and this to me really goes to the question that a lot of people are asking, Stephanie. Bank of America's Mark Cabana warning of Treasury market dysfunction, exactly kind of what you're referencing, writing, quote, U.S. Treasury liquidity has deteriorated amid weak demand and investor risk aversion. The market is fragile and vulnerable to shock. A Treasury breakdown is not our base case, but it is a building tail risk. As Stephanie, as you put it, is it a tail risk or is it actually a tailwind potentially giving to a rally with some sort of, I don't want to say pivot, but a sense that this cannot go on forever?
Totally can't go on forever. That said, the Fed's not likely to step in at this point, so this could get worse before it gets better. Eventually, we would expect that the Fed would step in the event of it becoming dysfunctional, but we're not at a dysfunctional point at this juncture. So it could continue for some time before the markets settle down.
Gregory, from your perspective, Stephanie was talking about how it feels very technical in nature. Do you have a sense, based on your on-the-ground view, of who is doing the selling, of where this is coming from, why the buyers are not stepping in?
I'm not so sure it's the selling. I think it's the removal of the buyers from the marketplace. The three big buyers have really stepped away from the market. Of course, the Fed, number one, is they've pivoted into QT. That's $95 billion of buying that's disappeared every single month. The banking sector, which was a huge buyer, they had to invest the reserves that the Fed was creating through their QE program. They've pulled away, and you've got a lot of really sort of frozen longs who have mark-to-market positions well below par. and they really can't sell those without realizing some accounting losses. And finally, overseas buyers have stepped away. If you look at Bank of Japan, Bank of China, et cetera, they were big takers down of treasuries, if you will, for an extended period of time. They've pulled back. So I think it's really an erosion of demand rather than it is sellers on the supply side.
It's hard to game out the bond market for sure, and a lot of equity analysts are trying to understand what this means for valuations over the long term if we can't get a sense of whether we do get some sort of violent reversal in yields back down towards something that we've seen and that's more familiar over the past few decades. Stephanie, from your perspective, have we seen the re-rating of valuations within the equity space on the heels of some of the yield market move, or do you think that that has more to go?
There may be some more to go, but we do think with equities trading close to 3,600, that's a time to start stepping in. We'd be buying on that dip. Yeah, it could get worse before it gets better, especially as the market starts to price in the recession that's likely to happen. But at this point, we would be adding to equities. We'd be buying industrials. We'd be buying technology at reasonable price. We'd be buying healthcare. So now is as good a time as any, both for the 60 and 40 side of your portfolio.
All right, well, we're going to be digging into that in the upcoming hour. We are looking at earnings as they've been coming out. We are more than 20% done. Earnings starting to sour with corporate America struggling to clear a low bar, at least in certain pockets. Share prices getting punished and disappointing results definitely are being making their mark. Right now, let's go to Bloomberg's Katie Greifeld for more. Katie.
Well, Lisa, you're right. Earnings season definitely ramping up, and it's not going great, I would say. You have hospital stocks under pressure this morning. That's after disappointing results from HCA Holdings and from Tenet Healthcare. Tenet down a whopping 22% after revenue guidance was narrowed. You also have Whirlpool and American Express under pressure as well. And this morning's price action fairly emblematic of this earnings season so far. You have expectations, like you said, they've been lowered dramatically, and companies are still managing to disappoint. You're looking at estimates now versus 3 months ago. S&P 500 third quarter EPS growth, it's currently expected at 2.2% for the third quarter. That figure was 6.3% on July 29th. Feels like a long time ago. And it's early still, but so far this quarter on track to be the most punishing for companies that miss estimates since at least 2017. That's as far back as our data go. The average one-day change for earnings misses is a 3.8% drop. But Lisa, we've got another big week next week, so we'll see how that goes.
Katie Greifeld, thank you so much. Chris Harvey of Wells Fargo reshuffling the portfolio in response to some of these earnings, but not necessarily the way you would think. You ditched just cyclicals and downgraded the big banks. Take a listen.
It's more of a macro issue than anything else. And if you look at how banks reported and look at the numbers, they popped, they're performing in line with the market. And we thought this was a good time just to step off this trade. Nothing that we really don't like about the banks, but we do think it's just more of a market perform. As we think about things too, sentiment or the macro sentiment's going to be an overhang, and we just don't want to fight that.
Stephanie Roth and Gregory Staples still with us. Stephanie, from your vantage point, how much is this really the story of this earnings season, that people are using whether stocks rally or whether stocks sell off as just a way to double down on their theses, regardless of what the earnings actually showed?
I think it's actually a function of margins remaining elevated. That sounds like a good thing from a stock perspective, but from a macro standpoint, we don't really want margins to remain high. That's challenging the Fed even more. That means the Fed has to go even higher to get the slowdown in the economy. If margins don't roll over, that won't allow the labor market to cool down. Why would companies start doing layoffs or really pause hiring if their margins remain elevated? So the fact that earnings remain pretty decent at this point is not actually a great thing for the long-term picture. That means the Fed's going to go higher, and it could result in a larger downturn than would otherwise be the case.
And Gregory, this is the reason why there have been such confusing signals right now from the credit markets. We've seen in investment grade, the sell-off has been really marked and much more dire than what we've seen in high yield, even though high yield, arguably more leveraged companies heading into a downturn, would have a difficult time. What do you make of that, this resilience in high yield at a time when investment grade is really seeing the biggest losses?
I think there's a couple of good reasons there. First off, I think a lot of the corporations used the last 2 years to really pre-fund a lot of the debt on their balance sheet, and they learned resiliency from the COVID lockdown. So corporations, I think, are a lot stronger. They didn't extend themselves in terms of debt. Clearly, a lot of the high yield market is in the energy and raw material space, which has done fairly well overall. You know, we have not seen the kind of widening in terms of spreads that you would see if you're seeing an economy enter a recession, whether that be an investment grade or high yield overall. You have to be a little bit concerned if you've got refunding coming up. The refunding markets are not closed, but they're close to. It's getting harder and harder to get deals done. So I think for the moment, we're just looking at the fourth quarter slowdown if potentially it happens. But as earnings come in the third quarter, this is not an economy that's in a recession at all.
So based on that, Gregory, are you buying the riskier securities even though they haven't sold off as much simply because the resilience really has been the story in so many sectors?
We're not buying them at all. I think there's probably actually some weakness that's coming ahead. The market hasn't recognized that yet. So we're actually moving up in quality and being a little bit more conservative, keeping cash balances, shorter maturities. We think that there's more potential widening to go in the fourth quarter.
And right now we are looking out also at tech earnings, which we're going to be getting into next week. How much, Stephanie, and we're going to dig into that more in the upcoming segments, but from your vantage point, how pivotal will that be to sort of set the tone about the re-rating and the fundamentals at a time when you actually see value here?
That will be important, but it's not exactly the story for the broad economy. So markets will certainly care, but when I'm thinking about the message for the rest of the economy, tech has been a bit of a divergent sector from the rest of the economy. It was benefiting from COVID. You're starting to see layoffs there, but that's not indicative of what we're seeing in the broader market. So certainly the equity market will be paying attention to it from a macro perspective. I'll be focused on some of the more cyclically inclined names. So far, Stephanie, when you look at the ones that matter, the names that matter for an economic perspective, what do you hone in on? What sort of stands out to you so far in the earnings season? So far, the message from the banks have been that the consumer's okay. And that's been sort of the trend that we've seen for the bulk of this year. Consumer spending has remained stable, maybe not strong, but it hasn't cracked on the back of Fed hiking. We expect that eventually it will. The housing market is certainly feeling the pain, but it takes time for it to filter into the rest of the economy, and we would expect to hear the message from company earnings, certainly from the banks, and then looking to hear what the consumer companies are saying. Stephanie Roth, Gregory Staples, both of you are sticking with us. We want to take a look right now at the stocks moving ahead of the opening bell. With that is Kaylee Lyons. Kaylee.
Well, Lisa, the big one this morning is Snap. Absolutely brutal, plunging the better part of 30% early hours after reporting the worst revenue growth, the slowest revenue growth on record after the bell yesterday. The company blaming a continued slowdown in the advertising market because as the economy slows down, apparently a lot of companies don't want to spend as much on ads. So that's taking Snap down and a lot of other social media advertising reliant companies down with it. You could argue Twitter falls into that basket, but what's happening there has more to do with Elon Musk today. First, you had the Washington Post report yesterday saying that if he does indeed succeed in taking over the company, he could cut up to 75% of the workforce, but it's an if he succeeds because Bloomberg also reporting that the Biden administration is looking at a potential national security review of Musk's ventures. The White House says it's not aware of that, so we are off of session lows, but still Twitter down about 5% in early hours and Tesla, for its part, down about 1%. Finally, I threw Spotify on here as well. Lisa, I don't think you're a Swiftie. I would guess not, but Taylor Swift's new album dropped at midnight, in case you weren't aware. And at the same time, Spotify was running into a lot of issues with users not being able to access it. So a lot of Swifties may be upset about that. Spotify down about 1.3% before the bell.
Kaylee, thank you with the Swiftie report. Coming up, Liz Truss leaves Downing Street.
I am a fighter and not a quitter. I am resigning as leader of the Conservative Party.
The turmoil ahead and who takes the helm next. That conversation still ahead. From New York, we are seeing equities lower, although actually they have flipped with 15 minutes to go, basically unchanged here as we head toward that bell. This is Bloomberg.
Most of us don't spend much time thinking about the grid. the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We are seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco. Britain in crisis.
I am resigning as leader of the Conservative Party.
The shortest ever serving Prime Minister.
Trust Bloomberg for the fastest coverage and instant expert analysis.
Is a general election enough to begin to restore some of the credibility?
It takes a long, long time for the markets to forgive you.
You are now, from an economic point of view, tinkering.
Brexit has not gone away.
Wake-up call here for the Conservative Party.
For continuing coverage, keep it tuned to Bloomberg Television and Radio.
I have a bold plan to grow the economy through tax cuts and reform.
It was becoming a distraction, so that's why we immediately changed that policy.
We will keep an iron grip on the nation's finances.
Mr. Speaker, I think the last thing we need is a general election.
I am a fighter and not a quitter.
I recognise, though, given the situation, I cannot deliver the mandate on which I was elected by the Conservative Party. I am resigning as leader of the Conservative Party.
A really rough 44 days for Liz Truss. The UK hoping to curb recent turmoil with a new prime minister. Markets are remaining on edge with gilts heading for the biggest weekly surge on record. This coming as currency traders brace for a possible intervention with the Japanese yen on track for 10 straight weekly losses. This is sort of the dueling stories of a strong dollar on the other side. Our team coverage starts right now. Tom McKenzie at Abingdon Green and Kaylee Lyons here in New York. Tom, starting with you, can you give us a sense of how much the markets are truly in control in the United Kingdom, even as they search for a new prime minister?
Well, the markets have put the parameters, they put the guardrails around this race for the next Prime Minister because it is made abundantly clear to the Tory membership, the Tory party, of course, the leading governing party, and everyone here in the UK, frankly, that you need to have sensible financial and fiscal policy, that the markets will punish you if you don't stick to the orthodoxy. Behind me in the Houses of Parliament, you do have that fierce lobbying now behind the scenes, a kind of mercurial atmosphere as the numbers start to add up. So the context is that you are likely to get 3 candidates who will be put their names to a ballot on Monday, around 9 a.m. US time. They have to have at least the backing of 100 MPs each. There's 357 members of the Tory party, so that leaves 3 candidates. Currently, the numbers coming through, according to the Bloomberg number crunches, is 52 for Rishi Sunak, the former Chancellor of the Exchequer, 52 MPs backing him, so he's more than halfway through. 28 for Boris Johnson, the former Prime Minister as well, in what would be a remarkable turn of events. This is a man, of course, who's cut his holiday short in the Caribbean to fly back to the UK to gauge the opportunity as to whether or not he throws his hat in the ring. And then there's the former Defence Secretary, Penny Mordaunt. She's currently got 16 MPs backing her. So that is the process. You get to Monday, it will get whittled down in that ballot of members of the Conservative Party to 2. It is likely that the follow-up will, the second person within that run-up will probably be pressured by members of the Parliamentary Party to step down. If they don't, it goes to a vote from members of the party outside of Parliament. The deadline is Friday, the 28th. That's when, at the very latest, they'll have to have chosen a new Prime Minister, but it could come as soon as Monday. You talked about the markets. Yes, today yields up, the pound down, but broadly, as you mentioned, yields have come off this week. Bonds and gilts have been bid. A crucial timeline for markets and investors is that fiscal plan that the current Chancellor says will be outlined on October the 31st, question marks as to whether or not that deadline will be kept, and that is crucial for markets.
It seems like Jeremy Hunt has provided the ballast for markets that they were looking for. Kaylee Lyons, we're looking around the world, and very much this is all the counter story of the strong dollar and yields going higher with the Federal Reserve hiking. It isn't just the United Kingdom that's being forced to respond. It's also questions about how Japan does, given that the yen right now is weakening dramatically to the lowest levels that we've seen going back to 1990.
Yeah, since June 1990, it's absolutely brutal. It has been brutal for everything in G10 up against the dollar this year, but far and away, it has been the worst for the Japanese yen. It has weakened nearly 32% against the dollar on a year-to-date basis. We are north of 151, so that raises the intervention question, because remember, we already saw it last month, and that was when we were at a 146 handle. Clearly, we've gone north since then, so that intervention wasn't necessarily effective. There's two things to consider here. One being that intervention rarely works when it's only one player in the game. You kind of need collective action. Japan did not have that. The other being there is still the rate differential problem in that every other central bank, most notably the Federal Reserve, is aggressively hiking interest rates. Japan and Kuroda at the BOJ are doing no such thing. So as we have seen yields moving literally hundreds of basis points in the UK, in the US, in Germany, we've gone 18 basis points on the 10-year JGB yield on a year-to-date basis. Why? Because it's capped at 25 basis points. Traders, though, are starting to test the Bank of Japan on that yield curve control. And a great chart here from our very own Valerie Teitel points out the hedging we are seeing for a break in the BOJ's curve control. Look at the swaps market, the 10-year yen swap at 65 basis points. That is 40 basis points north of the BOJ's target. So clearly, Lisa, the market here is saying something's got to give. Intervention in and of itself might not be enough.
And thank you so much, Tom McKenzie and Kaylee Lyons. This really speaks to what we were addressing with Gregory Staples and Stephanie Roth, who are still with us, about what happens when something breaks. Gregory, as you take a look at some of the FX moves, how much is that what's going to break first? Are some of these moves, particularly in Japan, unsustainable?
I think ultimately it is. I mean, obviously, if you go back to your macroeconomics in college, the Bank of Japan can do one of two things. They can control interest rates, which they're trying to do through yield curve control, or they can control their currency, but they can't do both. As long as they're generating an unlimited supply of yen through purchases of JGBs in the marketplace to control that 10-year rate at 25 basis points, it's going to flood the market with supply of yen, and they can't control the price. Probably won't change until Kuroda's term is over in the first quarter of 2023. But until then, it's going to be quite volatile, and I think continued upward pressure intervention is not going to change it.
Stephanie Roth, a final word on this issue.
We think that something is going to break, and we all spent the last couple of weeks learning about UK pension funds. That wasn't the thing that broke the market. But in this type of environment, something likely cracks, and we don't know exactly what it might be, but we're watching closely, and eventually central banks will have to step in.
And is there some sort of read-through with the Japanese yen and U.S. equities? I mean, is that something that you are parsing out?
I would say, it's surprising how well U.S. equities have held in, given what's going on in the backdrop. We think that a lot of the pain is in the price there. And certainly equities would rally if we do get some intervention from central banks. So we're watching that closely for sure.
My thanks to both of you. Stephanie Roth and Gregory Staples. Have a wonderful weekend on this Friday morning. Coming up, the morning calls, and later, bonds are back. That's the view of Amundi's Monica Defend. Seeing some stabilization in the bond market. Monica joining us around the opening bell here as we have a tumultuous session just moments away. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Flipping between gains and losses with 5 minutes to go. This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. We are now in the loss segment of this morning's flip-flopping. NASDAQ down 0.4%. The S&P down by just about 0.1%, really driven by the yield story. Yields have been much higher. They have been coming off some of those recent highs. Taking a look at that 10-year, 4.33 at 1%, now down to 4.29%. The 2-year yield at 4.5%. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Raymond James downgrading Lennar along with other home builders within their coverage, highlighting a stalling housing market and a lack of visible catalysts. Next up, Telsey Advisory downgrading Under Armour to market perform, $8 price target. Expecting earnings to fall short following disappointing results from Nike and Adidas. And finally, Bank of America downgrading Snap to neutral, cutting the stock's price target in half after reporting its slowest quarterly sales growth on record. Coming up, Snap fueling an exodus out of social media stocks ahead of a busy week of tech earnings. That conversation coming up next. The opening bell just around the corner. This is Bloomberg.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
No one covers the world like Bloomberg.
Because Trustonomics is being dismantled, MPs behind the scenes are asking what's the point of having her at the top?
Can the strong dollar amplify quantify the world's risks of instability?
Xi Jinping said complete reunification must be realized.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Countdown to the open. I'm Lisa Abramowitz in for Jonathan Farrow. Just moments away from the start of trading. NASDAQ lower by 0.5%. S&P fluctuating between gains and losses. The story has been the yield story, which have paired some of their advance. You had seen at one point 4.33% on the 10-year yield, now down below 4.3%, but really driving the action with this feeling of dollar dominance and yields ever higher. You are seeing that 10-year yield off the highs. The euro dollar is still seeing that weakness in the euro. Dollar strength 97.68, and you can see the yen climbing at one point very close, bumping up against 152 with the dollar stronger versus the yen. Joining us now with a look at the stocks moving ahead of the opening or at the opening bell. Here's Katie Greifeld. Katie.
Lisa, I have to start with Snap because it posted the slowest quarterly sales growth ever. You had advertising spending just absolutely in the gutter, a potential warning sign for other social media companies, but all the action in Snap this morning down about 27%. American Express, too, under pressure. It's still seeing good spending, but that strong dollar eating into guidance. And Amex, it set aside more for bad loans than analysts had expected. Shares off about 3% or so. But let's get to some good news. We're going to do that with CSX. Shares higher after the railroad operator beat estimates. Profit was up 21% year over year. The company also reiterated its full year guidance. Shares higher almost 3%. And Schlumberger posted its highest profit in 7 years, largely thanks to a big overseas pickup. You have drillers putting oil and gas rigs back to work. The company also said that sales and margins should expand in the fourth quarter.
Katie, thank you so much. Earnings season very much underway. Separating the haves from the have-nots. Bloomberg's Kaylee Lyons joining us now with the scoreboard. Kaylee.
Well, the scoreboard actually looks relatively decent, Lisa. When you look at the S&P on average, about a fifth of the way through earnings season, we are seeing earnings down about 1.7%, but the majority of companies are topping expectations, and that includes a lot of those that have seen the most reports already. We have seen about half of the financial sector reporting. 75% of those names have topped expectations. For staples, industrials, communications, all between 20 and 30% of the sector has reported, and we've seen very decent beats there as well. So a lot of those companies are getting rewarded. In the communication sector, for example, Netflix is one of the big ones that saw a nice post-earnings boost of about 13%. We've seen a nice lift for Lam Research, AT&T as well. But when you miss, you do indeed get punished. Union Pacific off 7% the day after its report. Comerica by 9%. M&T, those regional banks, getting hit pretty heavily. It was down about 14%. So as for how that translates onto a sector basis, in the last week, we have seen media and entertainment doing fairly well, as well as the airlines. They are still raking it in. A lot of people want to travel, even though fares are very, very high right now. The airlines index up about 2.7% on the week, but elsewhere in transports, it's a very different story. Look at the trucks. The trucking industry and the railroads, transportation down about 1%, and consumer durables as well, about 1.2% on the week, Lisa.
Kaylee, thank you so much. Social media stocks very much under pressure. That Snap decline, the biggest going back a long time, the most since July, just tremendous. It has paired some of those losses coming ahead of a monster week of earnings. Meta and Google on deck. Bloomberg said low, joining us now for more.
Yeah, this was a stock that in November was trading above $70 a share. How things have changed. We're now much lower than that, below $8 a share. One of the big questions is all of the issues that Snap outlined, a pullback in budgets among a broad range of advertisers, macro headwinds, the impact of inflation on the consumer. How much of this is transitory, Lisa? How much of it is specific to Snap? And most importantly of all, as we get into the meat of this earnings season, how much does this spread to other names? We have an incredibly tough week coming up next week with the likes of Meta, the likes of Twitter, although there's slightly artificial trading around that subject to the purchase by Elon Musk. What are they experiencing with the ad market here, and what do we read into this situation as a lens into the health of the consumer? You also have a slightly different take, of course, through Alphabet, the parent company of Google. You and I discussed this earlier. We went into this with a mixed opinion about technology. Potentially, the third quarter could have seen EPS hold up better in certain corners of the technology market. My goodness, are the list of problems and headwinds growing. I'm still excited, though.
Ed Ludlow, thank you so much. I'm excited, too. I think it'll be helpful to see exactly where things are at. Yields, meanwhile, continuing to soar higher and hitting pause on the latest equity rally. Investors wondering, is the honeymoon already over?
This is a very impatient market.
You don't want to get too comfortable.
It's way too early to say capitulation. I mean, I think that's heroic.
The Fed just started raising rates this March.
We have not seen the real impact of tighter financial conditions.
That means bumpiness in the market.
We've seen the market sell off a lot.
Investors seemingly have no tolerance for pain.
That potential capitulation, there's still work to be done.
We're going to get these bear market rallies.
The bear market rally, it's short, it's sharp.
Companies are battening down the hatches and getting ready for choppier times.
Before we can say this bear market's over. We need to see some of that weakness coming through.
We're going to be on this roller coaster to nowhere.
The roller coaster to nowhere that we're all on. Amundi's Monica Defend joins us also on that roller coaster to nowhere. Based on the roller coaster of yields ever upward, at least so far, how much have equities fully priced that in?
Well, we don't think that equity actually ever really priced in a prolonged recession. But if you ask me what are our working assumptions, we do frame the current outlook within an environment of earnings recession for this year and prolonged for longer higher inflation. And this is obviously reflecting into the equity path because the central banks on the other side, they remain quite hawkish. So let's see how much and what the terminal rate for the Fed, for example, will be. We stay between 4.75–5%. But this is what is really concerning investors amid earnings that are running under margin compressions and cash flows that have been reducing so far.
Right now, really the news of the morning has been in the yield space, with yields climbing to the highest level in the U.S. going back to 2007. Real yields also climbing to the highest levels that we've seen going back to 2009. And then there was a bit of a retracement after a Wall Street Journal article came out written by someone known as the Fed Whisperer, talking about how Fed officials are looking for a 75 basis point rate hike at their November 2nd decision. And then after that, more voices saying to pause. And how much, Monica, is that really a deciding factor for you in terms of how high yields can go, whether those naysayers on a Federal Reserve can really get their way and cause some sort of think, pause, wait for that lag time to take effect?
Well, we're pretty convinced that November and December we'll see no-kish Fed, so we are penciling in a 75 hike each. Then when we move into January and February, we'll see, but we do believe they will continue to hike. And it is unlikely that they will pause because it's their credibility that is at stake. So, and this was really, really clear to us last week at the time we've been joining the IMF meetings. If you look at the textbook Taylor rule, 6% terminal rate is what theoretically might help the Fed to go back to target in 2024. But in order to get there, the price that we are gonna pay in terms of earnings, margin compression, higher yields, and economic recession is definitely non-negligible.
Wait, 6% terminal rate, is that plausible to you?
I think that they will stop earlier, just because it is true that Powell at Jackson Hole said there will be pain to come. We really need to be focused on inflation, but such an increase, such a fast increase of rates might be detrimental at some point to fiscal stability. So as of today, hard data remain quite good, but we are seeing some cracking in the soft data if you look at the confidence indicator. And I don't think that really they can ignore all these kind of costs when it goes to fast increase of rates.
Well, perhaps they can't get to 6%, but the team over at BNP Paribas expects rates to rise past 5%, writing, quote, "We now expect a terminal Fed funds rate of 5.25%, thereby lifting policy rates to a sufficiently restrictive stance to cause recession. The recession is likely to start around Q2 2023 and endure for 3 to 5 quarters." Monica, from your perspective, how much does that really make the argument for cash, for remaining nimble, for not being overly invested as the markets catch up with a view that is increasingly higher yields and a Fed that has to do more?
Yeah, first, I agree with the fact that if we move into 6, we might have a prolonged recession that might last several quarters going into 2024, even before you see inflation cooling down. Having said that, it is really important to look at how the economic partner will evolve, and cash is a decent hedge, if you want, vis-a-vis this margin compression that honestly, spread compression, that honestly, when we look at spread, they've not been moving that much. And this is kind of weird, no? Because it means either the corporate sector is quite safe, and we do believe that they might have some solvency issue moving forward. But the resilience of the credit space, to me, has been really surprising.
Yeah, well, I agree. I mean, not that it's been surprising overall, but that in particular the high yield space has underperformed in an environment where people would say, well, typically the more leveraged companies would get beaten up the worst. How do you explain this? I mean, do you think that we are entering a credit cycle that people are unprepared for, or do you think this highlights the resilience of balance sheets that have really gotten flush with cash and pushed out maturities?
I think that there might be some cases of resilience where the balance sheet might really be being reduced, but honestly, we've been getting even more and more selective over time on the high yield, and in general, we do prefer investment grade to high yield. So maybe he's more on the investors' irrational, this credit resilience so far.
What's your sense about whether there are any spots within the equity space to hide, or if this is really, at this point, something that needs to be parked on the sidelines?
Yeah, definitely. Well, from a regional perspective, we think that the U.S. economy is still in a better shape when compared to Europe, and this is justify our preference for U.S. equities versus Europe. Then if you look at our sector allocation within Europe, staples, industrials, IT and utilities offer some nice opportunity. When it goes to the U.S., also the banks in the U.S. seems to be extremely resilient, and the healthcare sector as well. On the emerging market, we've been moving to the cautious side. We've been reducing also the exposure to China, which remains really a big question mark on what's next. We do believe that still the rebalancing has to take place in China, so further has to join the economy.
Monica Defend, you'll be sticking with us. Coming up, Musk's Twitter deal facing yet another headwind, this time from the U.S. government.
I'm wondering how much Elon Musk is regretting this impulsive decision to buy Twitter. It's been a huge distraction. It's definitely affected the Tesla stock.
That conversation coming up right now, just 15 or 13 minutes into the session, and you are seeing the whippy action turn to losses. The S&P down 0.4%. This is Bloomberg.
got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, we have a unique way that we look at big new investments. And I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs. And the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. This is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
There's been so many rumors about this Twitter deal. We don't know what is true and what isn't. And also, I'm wondering how much Elon Musk is regretting this impulsive decision to buy Twitter. It's been a huge distraction. It's definitely affected the Tesla stock.
There have been a lot of sagas, and this has been yet another one of them in the Twitter story. Bloomberg reporting that the Biden administration is weighing security reviews of Elon Musk's ventures, including his bid to buy Twitter. And of course, the department did come out and raise some questions about that after that report came out. Bloomberg's Ed Ludlow back to make sense of all of this. Ed, please help us.
Yeah, good morning, Lisa. There were 4 key reports on Thursday night, all about Elon Musk, all about Twitter. The first, as you said, according to Bloomberg sources, various individuals across various agencies in D.C. are looking at security reviews of Elon Musk and Elon Musk's businesses. This stems from his comments around the war in Ukraine, his comments around SpaceX's support for the use of Starlink in Ukraine, and of course, his purchase of Twitter. As you said, this morning, the White House has said it is not aware of any national security review of Musk Ventures in response to that Bloomberg report. The Washington Post reported that Musk is telling potential equity partners in this Twitter deal that he will cut the workforce by 75%. Bloomberg has confirmed that he is telling investors that. Twitter, in a memo sent to his staff, which sources shared with me, say there is no plan for company-wide layoffs. There were talks ahead of the merger agreement being signed in April about cost-cutting measures, but once the agreement was signed, those talks end, no plan for company-wide layoffs. And most importantly of all, in the background, Bloomberg News reporting, according to sources, bankers and advisors on both sides of this deal are getting on with it. They fully expect to have a document in place and for the merger to close by the October 28th deadline put in place by the Delaware judge, 5 p.m. on that date. We're also reporting, according to one source, that key banks are just waiting for any day now Elon Musk to call in that debt financing, and there's no expectation that the banks will hesitate in providing that $12.5 billion of debt financing. Those are the stories.
Perhaps because they haven't found the loophole yet in the contract. I have no doubt that they're looking for it. Ed Ludlow, thank you so much. Twitter not the only deal under the White House microscope. For more, Bloomberg's Joe Matthew joins us with other companies facing some regulatory scrutiny. Joe.
Yeah, we moved to high tech in this case, Lisa. It's interesting, the conversation we were having just a couple of weeks ago about the United States cracking down on exports of high-end semiconductors, chips used for artificial intelligence and supercomputing. We add another layer here with Bloomberg reporting that the administration is now considering clamping down in a very similar way on AI software and technology that surrounds quantum computing. This is very high-end technology that kind of moves beyond the ones and zeros that could really change the shape of high tech in the future here. And the United States does not want China to get its hands on this in what is now really looking a lot like an economic Cold War. In terms of the companies here, it is that, by the way, moving stocks without any official announcement here. These are just reports and early planning here. But Nora Technology, Chinese tech firms like ACM Research and Piotech are trading lower, Lisa, as long as we're also seeing some U.S. tech companies developing this technology trading lower today as well. Think Microsoft, Intel, and IBM. But it's not just tech that could take a hit from regulators here in Washington, as we learn now that two high-ranking senators on the Judiciary Committee, Senator Amy Klobuchar, a Democrat, and Republican Mike Lee, are calling for a hearing now in the Albertsons takeover, or at least proposed a takeover of Albertsons by Kroger. This is the big grocery merger that's been in the works here. We knew this deal would face scrutiny. Klobuchar and Lee, top officials again on Judiciary, say they have serious concerns about the deal. Antitrust concerns Klobuchar is pointing as well in a letter now to the FTC, which still seems to regret approving Albertsons' takeover of Safeway a couple of years ago that resulted in a bankruptcy and some spin-offs here. So I would expect a lot more conversation about this following the midterms that will begin with a hearing on Capitol Hill and will likely trickle to the FTC, Lisa.
Great work, Joe Matthew. And I'm just looking right now at Albertsons shares down more than 24% in early trading, perhaps in the heels of some of the pushback that was, as Joe said, expected because of the big antitrust push by this administration. Amundi's Monica Defend is back with us. Monica, we haven't really talked about the potential policy risk because there is a feeling that markets are in charge. Do you think that that is true, or do you think that there is a policy risk that perhaps is underappreciated?
I think that the UK really was an extreme case where we have seen how the trade-off in the policy might actually blow up and have dramatic consequences on the market. So it's really this a combination of fiscal and monetary policy at a time of very different target, because fiscal has to support the economic path, while central banks and monetary policy have to carve out inflation, to reduce inflation. So these two conflicting targets might really explode, as it has been the case in the UK. So hopefully this will be an insulated case, but definitely this is one of the risks we have on our radar.
How much does this really reduce how much borrowing there can be by governments and fiscal spending because of the bond vigilantes that have definitely spurred up?
Well, you really need to look at region by region, because, for example, in Europe, we have the other difficult task of fiscal solidarity, for example. So you have many countries that have to vote on unanimity in order to get a package, an energy package that can help the population. It is really not the same in the United States, where if you want, there was more desynchronization between fiscal and monetary. Honestly, it has been only in China where the two in tandem have been working together. But really, apart the bond vigilantes, I think that top down we might have an issue of a policy trade-off and a mistake.
Monica Defend, thank you so much for taking the time. Truly wonderful. Have a wonderful weekend. Monica Defend there of Amundi. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. We did see some flip-flopping action ahead of the opening bell. We still see that flip-flopping action. The S&P now up about 0.5%. It just highlights the real uncertainty and concerns about liquidity and where the next shock is going to come from. Lack of conviction. This is Bloomberg.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Time now for the trading diary, but before we get there, let's take a look at the flip and the flopping. Wow, it is flipping and it is flopping. The S&P now up 0.7%. Blinken, it might be down just as much. The NASDAQ up 0.4%. This comes as we see a retracement in the yields. They had been much higher. Now they're just a little higher on the long end. The short end, you're actually seeing yields come down. 10-year yields 4.26%. The 2-year yields 4.53%. This is the trading diary, what you need to be watching into next week. President Biden discussing the U.S. deficit at 11 a.m. Eastern. Looking ahead, U.S. PMIs on Monday. Tech earnings ramping up with Alphabet and Microsoft on Tuesday. Meta and Twitter reporting on Wednesday. And finally, U.S. jobless claims and core PCE, followed by an ECB rate decision and Lagarde press conference on Thursday. One thing that is notably absent is Fed speak because it will be the quiet period starting on Monday. This was Countdown to the Open. This is Bloomberg.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We are seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family
Connection lost.
Ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud, The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them.
Connection lost.
The neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small and, space is really big. And then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk